Okay, good morning to everybody, dear colleagues. Nice to see you. Many came back after the nice evening yesterday we had. So it's my pleasure to open the second day of the conference. We have actually quite remarkable program also for today. And we have a few sessions and a keynote by Michael Platzer. For the first session today we have two speakers, Gianni and Nicolo from Johns Hopkins University and Gonzalo from Bank of Spain. We will have first presentation by Gianni about an early warning system for tail financial risk, and then Louis will talk about do buffer requirements for European systemically important banks make them less systemic. So we are looking forward to these presentations. Please, Gianni.
Oops. Okay.
Just a moment.
Oh. Aha. Okay. Okay, good. So let me see. Perfect. Okay, thank you very much for selecting this paper. This paper is still work in progress, of course, aiming at improvements. But the basic stance, the basic idea is there already in the paper that is posted on the, on SSRN and will be posted also here in the Banco of Finland site. So what is the objective here? Well, as the title mentions, we are just trying to have a system or a set of tools to anticipate financial risks of the extreme form that is tail financial risks. And this can be done at the level of a single firm as well as at the level of a system. And this is a paper that talks about the system. So the motivation is pretty clear. The key point that I would like to mention is that this paper is on trying to merge the issue of forecasting risk with the issue of stress testing. And basically, we know that stress testing has become a technique or a set of procedures that are also very actually used every day, or regularly now in the context of bank supervision. And basically, in the aftermath of the crisis, we have set, or we have seen several formulations of measures of risk at the system level. And of course, this paper builds on that. But the key innovations of this paper is, or the key set of innovations actually, is the fact that we consider the models that we use to model risk or measures of risk as a set of tools that are not necessarily perfect. So instead of searching for the best model among a set of models, we are going to use them all. And we are going to select them in terms of what are the properties that they produce in terms of efficiency of forecasting and anticipation of actual events. So basically, we are using a set of potentially misspecified models. So what are the key innovations here is first, in order to reduce model risk, we diversify. How do we diversify? By using forecast combinations, okay? And the measures that I'm using are very standard in the finance literature, value risk, and particularly expected shortfall. But we are going to use them jointly because our function that, in a sense, classify and ranks these observations, these estimated entities is one that has to consider both these measures at the same time. The second innovation is that forecasting is conditional on some information at DIT. What is this information? Well, the information can be the current information, the baseline information, if you will. Nice expression used in many institutions, baseline. But we can also condition on a particularly stressed event. This is something that has been embedded in the notion of COVAR by Brunner-Meyer and Adrian and Brunner-Meyer. So we are going to use as a conditioning variables also stressed variables that will be COVAR measures. So in that sense, we have a sort of tool box that includes standard forecast for a particular model and its somehow stressed version. And we are considering them all. And we will see under what conditions these stressed forecasts are going to be introduced in the forecast combination and when they do that. So this is essentially a paper that is focusing on surveillance in real time. Now, the current, the paper is built on monthly frequency. However, it can be extended at any frequency we want to have. The current paper, of course, I'm updating the data, of course. So what are the three novel features in more detail? So at each forecasting date, we produce a set of forecasts, and I will tell you, the standard model that we use. But then we immediately, with the data window that precedes the forecasting date, we run a backtest. Typically, a backtest or a validation of the model is done at the end. You say, okay, well, let's do all these procedures, all these forecasts, and then at the end you say, okay, well, I hope that the backtest test will be passed. I would like to consider the fact that we can use this information before constructing the forecast combination. And then the valuation of this forecast is going to be, this forecast combination is a portfolio. To minimize risk of a portfolio, you try to minimize the variable, the volatility of this portfolio, given the a measure of forecast adequacy, of forecast performance. So the integration of stress testing into forecasting is, again, as I said, is just including these variables. And last but not least, well, okay, suppose that we have a nice model that historically has performed reasonably, and then in reality, you have a signal that says, well, okay, the risk might be higher. How much? So it is useful to have a sort of measure of the signal that your forecast is giving you in terms of possibility of evaluating whether the signal that you receive, even the wrong signal, is sufficiently bad to require some intervention, to require some particular action. So these are just the three novel features. Let me go then briefly. I'm just getting, I have 20 minutes, right? I mean, 20, 23 minutes. Yeah, 25. So I have my. So again, let me just describe the procedure, and then I will illustrate the results. So the forecasting methods. Methods meaning not only a model, a particular structure that you are assuming about the stochastic nature of what you are forecasting, but also the way you measure this in terms of length of the sample that you use, whether it is varied through time, whether it's fixed, and so on and so forth. So, and this application is so far done with a very simple 3 basic models: a model of returns of a portfolio of banks and a portfolio of non-financial firms, okay? So these are just the 2 sectors that we are considering. And the measure that we are going to consider is, or the model that we are building, is a model that models returns as a function of volatility of returns, so volatility of the returns in the market. In other words, we have a sort of a simple formulation of the relationship between returns and volatility, which is standard in finance, by the way. And the 3 models just differ from the way the volatility intervenes both in the mean equation and the variance equation. And the 3rd model is the only one that is somehow deviating from that, is the quantile model, that is, has been used many times in the literature, and we want to see whether it contributes to, in a significant way, to the forecast combination. So, how do we evaluate the forecast that we obtain from these models? I mean, the forecasts are pretty standard. I mean, there is nothing new or particularly fancy here. We use as an evaluation a scoring function that has been introduced, essentially specialized to capture the dynamics of both the value at risk and the expected shortfall, which is coming from this paper by Patton, Ziegel, and Chen, 2019. Okay. I don't want to say, yeah, I mean, the procedure is very promising. Let's put it this way, very modestly, because we have a good out-of-sample performance. We have stress forecasts that enter into the combination whenever you need most. That is, whenever they anticipate significant increase in risk. And the vulnerability signal also is very useful, and I will show you in what way that is the case. And anticipate, it also has a good forecasting, anticipation value. So, okay, the models I will skip. So this is the model where the return at horizon t plus h is a function of the volatility of this portfolio. And then you have the variance, okay, here is formulated in the standard kind of Garch type way. And then you have just the standard formula. So again, this is just a simple linear model with a volatility or idiosyncratic volatility that is just computed sequentially in time. But apart from that, these are the formula, and then we are just assuming that all this is a normal distribution. So very simple. The second one, the only variation is that the variance equation here is also depending on this volatility term or risk factor, and again, var and expected shortfall are just obtained standard, and then you have the quantile model. Again, all this is coming out of standard formulations, for example, just derived by Guriru and Lee at that time. So, but basically, we just have these terms. And okay, well, I mean, again, of course, you might say, well, why do you use this model? I mean, again, we just get results standard in the finance literature. So an increase in volatility induces a lower return, and this happens at any horizon for all models. So as you can see here, that's fine. Good. Now, the stress forecast, what are the stress forecasts? Well, we are stressing, what are we stressing? We are stressing, let me put it here, we are stressing this part, that is the risk factor. And the risk factor for each sector and country is going to be an autoregressive term, an autoregressive function that is including its own term and the leave out values, which is a simple average of all the other risk factors coming from different countries. So this is a country I of a sector, bank or non-financial, and this is the simple formulation which reminds me or reminds you a sort of a compressed VAR that we consider here. And then the process for this leave-out term is just a simple autoregressive term. So what do we do? Well, once we just compute this, and then this is computed with quantile regressions for simplicity. I mean, of course, we could use other formulations, but then we just use the COVAR, and then we condition these to domestic factor, because this is domestic, or if external factor, which is the leave-out part that determines the COVAR. So again, this is of course sort of a simple conditioning, everything else the same. So it's not a total, fully dynamic conditioning as it might have been in a sort of VR type of fashion. But the main point here is that you can certainly assume something different. The key message is that you can do it. You can do it, and you can condition your forecast on a stress. That is a stress. So this is the kind of complicated scoring function. I'm not going to go into the details, but this is a function that ranks the VAR and the ES, the value at risk, and the expected shortfall simultaneously, and it is consistent. It has a nice properties. Essentially, it's a legitimate scoring function, and importantly, it is negatively oriented. That is, lower is better. Okay, just remember that lower is better. So it has a negative orientation. So what is the back test? Again, here there are several techniques. I've been using so far the one that is adapted from the work by Engel and Manganelli by this PZC because we are using their scoring function. So, but other backtests can be used, so no problem. So, what are we doing? We get the H period ahead forecast. We have M forecast. Then we have a data range of estimation, a data range of evaluation. That can be overlapping, right? And then we are just running the, we just compute the score, and the forecasting strategy is implemented in 4 steps. Unfortunately, I forgot 1, 2, but anyway, the first 2 steps are just run the backtest and eliminate any forecast that doesn't pass it. Second, run a comparison test, Dibo-Mariano. This is a test that compares every forecast with every other forecast, and if a forecast is dominated or is worse, then at least one of the other forecasts take it out. So this is a trimming kind of a process. In the literature, it's called trimming. That is, you trim the set of possible forecasts to improve the forecast, the combination. But then, once you have this, done this, what is the best forecast? Well, you want to reduce model risk. How do you reduce it? You compute a portfolio, a minimum variance portfolio. Markowitz. No, nothing more than that. And then you will just choose the weights in the forecast that that solve this problem. And then you get this. Now, interestingly, this is a graph that is mapping the volatility of the scoring function with the mean, so mean variance. And interestingly, as opposed to a standard portfolio model, you have that, remember, orientation is negative, so you have that lower variance implies better prediction. Good, so this means that if you go for the minimum variance portfolio, you are just eliminating all this stuff here, and then you just go directly into the optimum or the best you can do. So now, again, so this is just an example. I mean, again, it is something that you have, just go. This is an example just with bad test, but I already. So, so what are the forecasts that we are using? I'm using the forecast of the three models by two rolling estimation windows, two stress specification windows, and then again, the back test is run on a window of 60 months. So we have 10 forecasting methods, but again, this is just a particular application. There can be more. And again, this is tells you what is the percent at each date that a particular model that is used enters into the forecast combination. And again, very quickly, you can see that all models contribute, but it depends on when. So, and the stress also, the stress combinations are also contributing. And in particular, the baseline, when we take the average over all these samples and so on, the baseline, so the mean, 90% of the selections are from the baseline models, and 10% are from the stressed models. Okay, this is just there are a lot of pictures in the paper, and they will be also cleaned up. Last point, last second, is the following. You know that one of the most popular measures of risk has been introduced by Engel and Brownlee and Engel, the S-risk. The nice thing about the S-risk is that it's a sort of a measure that is not closed form. It is based on a notion of externality, that is when the total capital in the banking system is low relative to an expected shock, then you will have a problem. These forecasts that I produce, fortunately, are just really very, very close to the S-risk, which can mean maybe two things. S-risk is great because it captures exactly what a more general formulation might capture. But of course, there are also differences. And lastly, the second, quickly, the second part is the vulnerability index. there is a huge discussion about how to classify ex post events that are extreme, banking crisis. So Romer, in an article, on a relatively recent article, produced a stress index based on textual information, claiming that that is anticipating the actual occurrence of certain systemic risk realization. The vulnerability index that I produced is exactly reproducing this, and actually, and I'm going to work a little bit more on describing in detail where the forecast combination beats the textual crisis indicator. Okay, that's it. Thank you. So I'm waiting for any question or any. I went pretty quickly, so.
Any questions from here or anything?
Of course, I'm very open to any question later on. Yes.
I think that
First of all, thank you for a very interesting presentation. I was wondering on this like sort of model averaging method that you were describing. So, I mean, a standard way is this sort of base and averaging where we have these sort of probability weights, and there's a very clear heuristics around that. So my question is there a similar sort of heuristics one can use, or some sort of very quality way how one can understand what the method is really doing, like aside from the sort of math? Like
there are several methods in the literature. The simplest method, I haven't thought about that, but I consider that in the paper, is to take simple averages, simple average. And they perform very well. In many applications, they have been performing even better than more sophisticated computations. However, most of the literature, and this is also a novelty of this paper, is based on forecasts based on root mean square error, I mean standard regressions, not on measures of tail risk. So that is not necessarily the very good comparison. However, there are several other methods. Bayesian averaging is one, where according to the probability, the prior probability, you just average the models. There is another system called Mallow, which is something similar to just taking the root mean square error of a particular forecast and determining the variance. So again, relationship between expected performance and risk of this performance, right? So in this case, I think that this is relatively new to treat this explicitly as a portfolio problem. There is somebody that has done it in limited fashion in the context of again, the standard root mean square error formulation. So again, my conclusion is that any of these, so the logic of the portfolio structure that I consider is very simple. You are just reducing the variance, period. And you just consider this rate. And the fact that there is this unexpected relationship between the variance and so lower variance, better return, because you can consider these forecasts as assets that you invest in, and you get the result of what? Well, in this case, a surveillance system. So again, the logic to close, and I hope that I have addressed your question, is the logic is depending on what is the weight you assign to the errors, or to the volatility, or to the possibility of making mistakes. Because you can have, on average, a great forecast that passes all the standard tests, but then across time, you are wrong most of the time, but you're on average, you're right. So that is exactly what this is addressing. Remember too that this is done sequentially every single date, so it's totally time varying.
Well, thank you for the clarification. That was a great answer.
Thank you, but again, yeah.
All right, I think, Gianni, this was indeed very, very interesting, and I think for the policymakers a useful tool. So we have to really digest still, because you had many formulas. We didn't completely maybe get all the points, but we will look this, and I think it's a promising.
Well, remember that I was at the IMF.
I know, it's very, very useful. So let's give a big applause to Gianni.
Okay, thank you. But anyway, so any question about this, we can talk.
We'll talk over the coffee.
Yeah.
So Luis, you're next. So please. Actually, one point to the presenter. So, if you are pointing to with the laser pointer to the screen, also explain that, because what you're doing, what you're showing, because apparently it's not visible to the people on stream. So they wouldn't understand if you're pointing somewhere. So please just explain what you're showing at the same time. Louis, please, the floor is yours.
Do they see if I use the...
I think they see that, yes.
Okay. So maybe I do that. Maybe from here. Okay, good morning, everyone. First, thank you to the organizers for selecting my paper. Also, thank you for the sauna and the nice event yesterday. And thank you all for being here in the first session. So I'm going to present this work in which we try to see whether the recent capital requirements for systemically important institutions have been effective in reducing the systemic risk posed by these large institutions. This is joint work with my colleagues from Banco de España, but as usual, whatever I say here shouldn't be taken to be the position of the Bank of Spain or the Eurosystem. The outline of the talk is very straightforward. I will give some introduction and motivation. Then I'll describe a key point for us, which is how we measure systemic risk and why we use this risk measure. Here, the previous presentation helped me out a little bit, showing that this is, in some sense, good measure. So thank you. And I will then just go into the more core of the paper with the methodological approach and data set, and then I'll describe results and conclude. So it might not be needed to say it here, but as we all know, since the global financial crisis, the idea of systemic risk has become a central topic in policy discussion and also in research. And by systemic risk, what we have in mind basically is the possibility that the whole financial system might cease to function properly. So there is some possibility that there might be some serious impairment, not on single institutions, but on the general financial system, which might affect the real economy as well. And one can distinguish two dimensions of systemic risk, the cyclical and the structural, or the time series versus the cross-sectional dimension. About the cyclical dimension, this basically looks at whether this risk of a serious disruption changes over time. And an example of this type of analysis is the previous presentation. But here we will be focusing on the other dimension, which is the structural. And here we basically look at whether there are specific institutions which have an outsized influence on the systemic risk of the system. And a particular aspect of this structural risk is the too big to fail problem, whereby some institutions are deemed to be too big to fail, because if they did fail, this could cause substantial disruption, which basically is systemic risk. And Basel III was mindful of this issue and proposed at least partial way to address this problem, which is to set up specific capital requirements for systemically important institutions. And these capital requirements are in the form of buffers, which we can think of as basically soft capital requirements. They are soft in that, as opposed to minimum requirements, these buffer requirements can be breached temporarily, but if they are breached, there are limits set up in the amount of profits that the banks can distribute through dividend payments or asset buybacks. So, but basically these buffers are capital requirements that sit on top of the minimum requirements, and the ones I'm focusing here are specific for systemically important institutions. There are two types. There are the globally systemically important institutions, which are set up by the FSB, at least the list. And then there are the other systemically important institutions, or domestically systemically important institutions, which are identified by the local authorities. And within Basel III, among the objectives cited to establish these buffers was, on the one hand, to increase the loss absorption capacity of these large institutions so that they would fail less. Also limit the negative externalities posed by them. So as we have argued, if they were to fail, this would create disruption beyond their own activities. And those are externalities that we need to somehow tackle. And also reduce moral hazard incentives, because this too big to fail idea implicitly establishes a subsidy, and so induces possibly excessive risk-taking. And so setting up a requirement which is larger, the larger the contribution to systemic risk of the institution is, in a way can counterbalance this moral hazard incentive. And so the Basel Committee set up some criteria to identify systemically important institutions, which basically revolve around size, importance for the real economy, complexity, cross-border activity, and interconnectedness in the financial system. So, okay, so basically the Basel Committee recognized that there is a cross-sectional structural dimension of systemic risk, and they proposed that capital buffers specific to these institutions would be in part able to reduce the systemic risk of the institutions. And the question we try to shed some light on here is whether these buffers have really been effective. So they were designed with this in mind. So have they really been effective in reducing the contribution to systemic risk of these large institutions? So a first way to answer this question would be to just look at the effect of other capital requirements, since in the end these buffers are just capital requirements specific for large institutions. And of course there's an important literature looking at exactly this question. So we can first have a look at what others have found. And there are first a set of works that look at time-varying capital requirements of the countercyclical capital buffer type. And in general, they tend to find that these capital requirements tend to decrease lending in the short term. And they can also be effective in reducing the size of the financial cycle. If we focus specifically on OSI buffers, on buffers for systemically important institutions, there are also a number of studies that analyze their effect on lending and also level of capital and CDS spreads. And they tend to find, in CDS spreads, for example, they tend to find a negative effect. So increasing the requirements for these institutions in the short term tends to increase the CDS spread, but it's very short-lived effect. So after a few days, it comes back to normal or even becomes negative or lower than the baseline. Now, if we focus on effect on systemic risk in particular, there are a few papers. An important one is this by Bostancic, in which they look at a very particular event, which was the EBA exercise that in 2011, it established that larger banks had to comply with a higher capital requirement within 1 year. And Bostancic find that, and co-authors find that systemic risk actually did increase, but also in the short term only. So the evidence in general is not about the effect of these buffers on systemic risk. Sorry. It's not very large. There's not a lot of it, so we try to contribute in this way. And our objective is very simple. It's just to investigate whether imposing these higher capital requirements for large systemically important institutions has been effective in reducing their contribution to systemic risk. And we will also analyze the adjustment channels. We see what are the possible channels through which this might be happening. And what we find is that indeed, in the European sample that we analyze, systemic institution buffers have been effective in reducing the systemic risk of these institutions. And we find that increases in equity play a prominent role as a channel to obtain this effect. So for us, in order to do this analysis, a key problem for us is to quantify systemic risk. Systemic risk is, by its nature, a multidimensional quantity and is difficult to quantify in a single number. But there have been some attempts to do this. And here there are, of course, a number of proposals how to measure systemic risk. None of them is perfect, but I can cite here at least two types. First, there's a family which is purely market-based indicators. And here also the previous presentation gave us a little insight into some of these, or use to some of these ideas. And first, there is just the value at risk, which is simply a quantile of the possible market value of a company. So lower quantiles would correspond to higher risk. And elaborating on this idea, there is the delta cobar by Adrian Brunner-Meyer, which basically looks at how the bar of the whole system changes if a given institution is in its value at risk. So basically, in this way, it tries to capture how one institution being in problems translates into the whole system being in problems. There is another set of measures which combine market information with balance sheet data. And in that sense, they can be considered to be semi-structural. And in this family, there are these related papers. There is first the the systemic expected shortfall, and then the ES-risk by Achari et al. And also Brownlees and Engel. And this is the measure we are going to be focusing on. So let me spend a little bit of time explaining to you what this measure actually is and why we think it's reasonable. So the risk measure is simply the expected capital shortfall that an institution or the whole system, here we focus on individual institutions, will suffer in the case that the whole system is in distress. And the capital shortfall is defined simply by this formula. Here, this would be the liabilities of the system, of the bank, sorry, and this is the market value. So those are the quasi-assets of the system, the market value of its assets. And this corresponds to a prudential fraction of the market value of assets that the market considers that the bank should have in the form of capital. So if the market value of the institution is lower than this fraction of its quasi-assets, then there's a capital shortfall. And what risk does is it computes the expected value of this capital shortfall in the event that there is a systemic crisis, which it's implemented by conditioning on the market return falling more than a given fraction in a given horizon. And typically we take 10% fall or more within 1 month. So the idea here is if the system is in crisis, implemented here by these very low returns in the whole market, what is going to be the position of a given institution? And why is this a measure of systemic risk? Well, the idea is that if during a crisis the bank is short on capital, at that moment it will be very difficult to raise capital. It will be very difficult to have retained earnings or any other form of producing capital. And so it might even need recapitalization, or it might need to make fire sales, which will also transmit to the system. And indeed, Achari et al. Have a model in which this is precisely the cost that is imposed on the system. And this formula can be rewritten in this form if we define the long-running expected shortfall basically as this expectation of the market value, which is the one that matters once we assume that the debt is constant in the event of a crisis. And here we have the formula. So here everything can be measured. The debt and the market value can be measured. But what's not measurable is this long run mean expected shortfall. I'm going very slow. So basically everything is measurable except the long run mean expected shortfall, which is basically how much the institution is going to fall in the event of a crisis. In order to estimate this, we follow Brownlees and Engel in using this DCC guards model by Engel, which basically models how the variance and the correlation between market and bank vary over time. And of course, one can be doubtful of whether this type of measure, which we estimate during normal times, is going to be effective in capturing a very large drop. And so we were not sure whether this would be actually good. So we did a little validation exercise because we were lucky in a sense because the COVID crisis offered us a shock basically of this type of magnitude, since during March, the European equity market decreased by 10% in 1 month. So this is exactly the type of shock we were looking for. And then it actually kept falling, so it was even larger than the type of shock we were using. So this allowed us to validate whether this type of procedure actually gives reasonable expectations of the type of fall that individual institutions would suffer in the event of a systemic fall. And here the solid lines are the actual market value decreases of Spanish banks. And the dashed lines are the ones predicted by the long-run mean expected shortfall estimation, which we carry out using only data pre-COVID. And what we find is that on impact, the market fell like around 10%, and the prediction for the different banks is reasonable for most banks, except this one here, which fell significantly more. But this one ended up being absorbed by this other one. So for most banks, it's pretty good. And what's interesting is that even beyond the 10%, if we rescale the expected fall by the actual fall in the market, we see that even for significantly larger falls than 10%, the long-run expected shortfall does a pretty good job, at least for large banks. This is ordered by size, by bank size, and for large banks it's pretty good. For smaller banks, not so much, but on impact it's reasonable. So with this, basically, we are happy. We consider that indeed this type of estimation gives reasonable results. And I should speed up a little bit. So for us, we focus on risk because we think it's a good measure in that it captures key dimensions relevant for systemic risk. On the one hand, leverage, because it looks at both liabilities and market value. So it could be market leverage. And also, implicitly, it also focuses on interconnectedness because it looks at how the return of the bank is related to the return of the whole market. It's using only publicly available data, so this makes it transparent. Anybody can compute it. It uses high-frequency data, at least through the market value part, which makes it able to detect sudden shifts, and so it makes it useful for monitoring. And through the market value, it incorporates forward-looking information. It, of course, has also limitations. First, it's based on market data, so it can only be computed for publicly traded banks, not for smaller banks. And it reflects market perceptions, which do not necessarily, so a fall in market value is not necessarily linked in the end to a loss of regulatory capital, so it might not be really capturing a possible fall institution. But anyway, it's used by a number of institutions, in particular central banks. Many of them are at least experimenting with this measure. And so let me now come to the model itself, the key of the work, which is very simple. So that's good. Basically, we do a panel regression in which the level of risk of each institution is regressed on bank fixed effects. So we focus on within bank variation. We include time series effects for general trends. Our key variable of interest is this coefficient, which links the buffer level with the level of risk. And then we have controls, including bank controls and country controls. Beyond the level of the buffer, we also look at simply an indicator function, which takes the value 1 whenever the bank is in the list of globally or domestically systemically important institutions. And a signaling variable, which takes the value 1 only on the quarter that the bank becomes first part of the list. Another one, which takes the value 1 when the bank leaves the list of systemically important institutions. And we focus on quarterly data from 2008 to 2021. European banks, we have around 170, which are the publicly traded ones. And let me go into the results straight away. So here we have the results for the level of the systemically important institution buffer and how it affects its risk. If we take the full data, we see that the level of the buffer is not linked to systemic risk. But if we focus on the pre-COVID sample, we do find a negative and significant effect. And we think it's reasonable that we actually should concentrate on this sample, because during COVID, this risk level increased a lot, then it decreased a lot as the market value recovered, but also several European institutions released the systemically important buffers, so this created like a spurious negative correlation between decreasing the buffer and decreasing its risk. So once we focus on the normal sample, we do find this negative and significant clear correlation between buffer and level of risk. If we don't look at the buffer level, but just as an indicator of being listed as systemically important, there is also a negative significant association between this and the level of risk. But if we look at the indicator of first appearing on the list, so basically this indicator is only the quarter that the bank becomes systemic, then the effect is the opposite, it's positive. And so we investigated this in more detail through local projections, which allow us to see the effect forwards in time of appearing first on the systemically important institution list. And what we find is that on impact, the systemic risk indeed increases, but over time this effect decreases and eventually becomes negative. And we interpret this as indicating that on impact, being systemic is bad because it creates a new requirement that the banks need to fulfill. But over time, banks can adapt to this new requirement. And is this adaptation the one that leads to the systemic risk decreasing? And here we explore the possible channels that banks can use to adapt to the higher requirements. Of course, they can choose either to increase their equity or to reduce the denominator, so the risk-weighted assets. And of course, both have costs. And here we do like a first stage type of analysis in which we look at whether the level of the buffer is associated with increases in equity. And we find that indeed it's associated with increases in total equity, as found, for example, by Dautovic and others. And it's also associated with the main elements of total equity, retained earnings and equity issuances, both of them, although total equity is stronger. But we find no association with the risk-weight density. So we find, as opposed to Bostancic, we find no effect of increasing risk-taking. And here, what we do is, this is the same effect as before, for reference. And what we do in the column number 2 is to include as additional control the total equity of the bank. What we find is that the total equity itself is negatively associated with the level of systemic risk, but more importantly, what we find is that the coefficient of the level of the buffer decreases significantly. Those are statistically significantly different. It decreases significantly once we include for the control of total equity. So we interpret this as total equity being a channel, so the effect of this buffer is mediated by total equity, and once we include explicitly this channel, the effect of the buffer decreases around 25%. So it's at least a channel which explains part of the effect. If we look at the main components of total equity, retained earnings and equity issuances, it is retained earnings that seem to have a more clear association with decreases in systemic risk, and also has more effect on reducing the coefficient of the buffer. While average risk weight density has no effect, that has very little change in the coefficient. So we conclude that the channel that we find to be important is the channel of increasing total equity. And with this, I reached the end of my presentation. We have found a negative link between the level of systemically important institution buffer and the level of its risk. Not just the level of the buffer, but also just being designated as systemically important is also associated to decreases in systemic risk. But what we find is that on the short term, being designated as systemically important institution is associated with an increase in systemic risk, but over time this association decreases and eventually becomes negative in the medium term, which we interpret as the level of risk decreasing only once the banks have time to respond and adapt to the new requirements. And indeed, the impact of the buffer level on risk decreases when we include the channel of total equity, which indicates that indeed it's an important channel for this adaptation. And the effects we found, I didn't explain this, but they are relatively large. So basically, a 1% increase in the buffer, or 1 percentage point decrease in the buffer, is associated with a decrease in risk of around 13%, which is pretty large. And so the conclusion is that indeed, it seems that these buffers designed to decrease the risk posed by these large institutions have been at least partially effective in doing this. And with this, I welcome any question.
Thank you very much, Louis. It was going to the heart of the macroprudential policy making, and let's give Steve the first question.
Well, we'll see if I can be coherent. So I'm a huge fan of S-risk. It's important, however, to understand one thing about how S-risk is computed, which is that you assume something about the leverage ratio. This is K in your original.
Yeah.
And the question, so the first thing is that S-risk, you can think of S-risk as having two parts. One of them is the part that's associated with what I would call a baseline shortfall of market value of equity from the, so regardless of the first part of the expectation, the baseline of that could be negative, okay? And so that could be part of S-risk. And then there's what I would call marginal S-risk, which is the part that's associated with whatever you assume the equity market decline to be, and then the associated covariance of the equity with that, okay? So that's the bit that you have on the right. So those are two separate things. And so the first question that I have is whether or not you're separating those, because those have very different implications. One of them is essentially the statement that your current level of market value of equity is insufficient to meet the current requirement. The other one is that you're overly sensitive.
Yep.
You have a beta, basically, that's high, okay? And those seem to be very different things. Now, the second related to that is the fact that when you impose a buffer, in some sense, you're changing K. So in some sense, what you have to ask now is not whether or not their S-risk has gone up in overall, but whether or not their baseline shortfall has gone up, or whether or not their marginal S-risk has gone up. So that's the first question, is whether we're going to do that. The second one is about the fact that these banks are very different in size. You have 170 or some banks. Only some of them are very big, some of them are small. And you find these, and you estimate your equation, if I understand correctly, on the actual euro or dollar value of S-risk, not on the fraction of S-risk relative to assets or something like that. So I'm sort of wondering about the fact that there are these big differences in size, and I would have thought that the natural measure would not be euros or dollars or whatever your currency is, which you didn't say, and that you're going to tell me that the number is like 2 billion or 650 million, but that it's some fraction of that, because then that would seem to me make more sense. Have you looked at that as well?
Yeah,
Thanks.
so thank you very much. Very good questions. First, as you very well explained, this risk has these two components. One would be the baseline leverage, but then there is the effect of basically volatility and being correlated with the market through the long-run expected shortfall. As risk combines both, because the idea is typically this long-run expected shortfall is going to be. But you can separate them. And if the question is whether we have looked at the two elements, we have, and what we find is that it's mostly the effect through market value. The long-run expected shortfall itself doesn't seem to change much. We don't find a lot of effect with or a lot of relation with the buffer. So it seems to be mostly effect through market value. Yes, the baseline is risk. And regarding the other part, yes, this is also a very good point. Indeed, our baseline specification is in levels because we think that size is an important component of systemic risk. So we kind of want to weight more larger banks. But as you suggest, this might be kind of potentially misspecified. So we have alternative specifications. We have here at the end, I think, one in logs, which might be a little bit more reasonable because then we are looking at percentage changes and not dollar changes. And we find like a 13-14% effect, and we also looked at the effect normalizing by assets or by market value. And we found similar effects, but a little less clear. So I didn't include it here, although we explore it. And the problem with logs is that its risk can be negative, and then we kind of lose those banks with negative risk. And also, to account for size, we took the baseline to be in levels, although maybe it's not the best way to do it. Maybe we should do a weighted, use the log specification or use the normalized specification and then do a bit more math to weight differently. But yeah, thank you.
If I may, actually, Louis, I think what was very nice that you had actually a lot of banks. So you had 170 banks. And to me, it was fascinating that you found a result that, that buffer had an impact beyond of the normal capital that you controlled for. So actually, I wanted to ask if you are considering of expanding the analysis, also looking other macroprudential, so micro versus macro type of buffers, because it would be interesting to understand whether capital is capital or whether there is a difference between different buffers, for instance. So you could think about that if you want to expand for the other capital buffers.
Yeah. So we include those as controls in the regressions. So like the CCYB, CCOB,
okay, you already
systemic.
Sorry, I missed that.
Yeah. The CCYB we believe is very, very endogenous because by definition it's going to be settled based on the local country conditions. And so, still we find a negative effect, which to me is a little this is not really what I wanted to show. Those are the baseline results. So yeah, the CCYB has a negative effect depending on the specification, but in our main sample, indeed.
But I think we would need to better understand this thing that what you have done there. At least to me, it's quite interesting to see that you did it what I actually asked for, but I didn't realize it. So sorry for missing that. But okay, it could be a little bit difficult to understand all the how to sum up all those effects because some of them are positive, some are negative.
Yes.
Okay, we are running a bit out of the time, so we are eating the time for the coffee break, but there are two good questions Actually from South Africa, Pierre Mananga has asked, S-risk and other methods in the fields of econometrics and statistics attempt to extract signals from market data to estimate systemic risk. However, they have been subject to criticism. For example, the ECB has expressed concerns about their efficacy of market data in precisely capturing the build-up of systemic risk, arguing that it could only be adequately assessed ex ante through exposure data monitoring. How do you consider this criticism?
I mean, of course, this risk is not perfect. It's not a perfect measure in any way, but we think it's a reasonable one, and we took a stand that we believe it captures at least some aspects of systemic risk. And for example, in the previous talk, thank you for that, we saw that it actually, at the aggregate level, also captures has some early warning properties. And so I wouldn't claim it's a perfect measure, it's the last word on systemic risk, by no means, but we think it captures some of the phenomena, so we are happy with it so far.
Okay, let's give a big applause to Louis. And we can go for the coffee break now and go back at 11.
You have a better answer to that.
Good morning, also from my side, and welcome to this second session of the second day of the conference. My name is Jukka Topi. I'm from the macroprudential policy side of the Bank of Finland. And the focus of this session would be the borrower-based macroprudential policy tools and their various effects. As a kind of practitioner in the field, I'm very happy that we have two very interesting and in my view, policy relevant presentations. We have Kasper Roszbach from Norges Bank starting with a presentation and a paper on the effects of the LTV limits on labor markets. So, as a reminder, just that the presenters have like around 25 minutes and there's 5 minutes for discussion. But without further ado, Kasper, please.
Thank you, Jukka, and I just want to thank the organizers for having me on the program. It's always great to be at the Bank of Finland, and probably for many who have been traveling before. It's been a while that I was here, so it was really fun to be here. But I also noticed that a lot of changed actually in some years, so it's always fascinating to see what this does, kind of a mental time lag. So this is a joint project with Gazi Kabas, who used to be in Zurich as a PhD student and who's now an assistant professor in Tilburg. And it's about the price of leverage, learning from the effect of LTV constraints, loan-to-value constraints for those who are not into the particular field on job search and wages. So let me just sort of say exactly what we're going to do. We want to investigate if household leverage affects job search, matching in the labor market, and wages. Now, why are we interested in this? I think we all kind of know that household borrowing is of great importance to the economy. It has benefits and it has some costs. And I think the financial crisis, which seems extremely distant at the moment, made this role of household leverage and also job displacement kind of very salient for many people and for the economy. Triggered a lot of research that gave us a number of very basic, but I think important and fundamental insights. Things like the fact that credit growth is a very robust predictor of financial crisis. We know that rising household relative to GDP is sort of presaging lower GDP growth. But there's also sort of, apart from this sort of macro evidence, there's also quite some evidence on the micro properties of debt. So, for example, we know from a nice paper by Shaw and co-authors that scarcity can lead to shifts in attention, and these shifts in attention can explain overborrowing. And overborrowing can, of course, reinforce, for example, conditions of poverty. There's also interesting research on the effect that job loss has on factors like health and life expectancy. And there's a nice paper by Sullivan and von Vector that actually shows that losing your job can reduce your life expectancy by 1 to 1.5 years on average. But this effect tends to be bigger as you lose more of your income. Now, I'm not going to talk about this literature, but I do kind of want to stress a little bit that there's a lot of evidence both at the macro and the micro level that suggests that it's important to look at the role of debt. I think particularly these sort of macro aspects then sort of have led many countries to introduce policies after the financial crisis that try to prevent this costly buildup of debt. And I can just sort of very quickly show this graph. So if you look at the year 2000, there were really very few countries that had sort of debt restricting measures aimed at households. And if you then look at some years after the financial crisis, you see that these policies really spread all throughout sort of the developed world and emerging economies. So we kind of want to take a new perspective on macroprudential policy and its interaction with the labor market. As I said before, we want to look at how does household leverage affect wages through its influence on job search. Now, why would you get interested in this question apart from the motivation? Actually, if you look at this data for Norway and you just plot the starting wages of workers against their debt-to-income ratio, you see that there is a negative relationship. So workers who have higher debt ratios relative to income actually have lower starting wages in their jobs. Now, this is just a correlation, so it doesn't tell us anything about causality, but it's a good starting point to look further on and see if we can say something more of a causal nature. Now, I'm not going to have any time to go through the literature, but I do kind of want to say which literatures we touch upon and also just sort of pay my dues to the people who have done a lot of interesting and important work. So this paper is sort of going to relate to three strands of literature. One is, of course, the literature that looks at the effects of macroprudential policy, costs and benefits. There's also a really interesting literature that looks at the interaction between household debt and credit access and how that affects the labor market through a demand channel. And I just want to say here, what we mean by a demand channel is that, household leverage has this detrimental effect on credit availability through either financial stability or a collateral channel, and that can trigger household deleveraging. And when households delever, that create a drop in spending and a rise in unemployment. So this is sort of the demand channel of debt. And there's a third literature that looks at the effects of household balance sheets on job search. So this interesting work about the US, how, for example, households who end up having negative home equity become less mobile in labor markets and which negative effects that has. Now, on macro-pru, on the first strand of literature, I just want to say this thing that, at least my sort of description of the current state of the literature is that there have been quite some papers that have shown that these macroprudential borrowing constraints can improve financial stability and limit sort of the assumption of debt. But I think there's sort of an increasing interest now that people have sort of established these basic facts on potential adverse side effects. So there's a really nice paper by an economist at the Dallas Fed, Nissen, which actually just came out in the Review of Financial Studies. And she finds that in Israel, when you introduce these borrowing constraints, affected households become less mobile, and they're forced to sort of move into the fringe of cities. Maybe exaggerating this a little, but they have to move out of the core of housing markets. And then I have some co-authors, including my colleague Knut Aronstveit, who look at the liquidity effect of these measures. So when you force households to make down payments on their mortgages, they're going to use the liquidity that they have. But when you spend your savings on making a down payment on a home, you will end up becoming less liquid afterwards. And that makes you potentially more vulnerable to shocks. And then a reasonable question to ask is, what is the balance of these positive and negative effects? When households have less liquidity, how much do we care about their deteriorated ability to manage financial shocks? Okay, so I think what can then our paper potentially contribute to these three strands of literature? I think one important thing is that having more evidence on the pluses and minuses of macroprudential policy can inform policymakers who need to calibrate macroprudential policy. Because there is this fundamental question of how do we trade off these positive effects of, let's say, having less severe crises or downturns against the disadvantage of actually constraining households in their choices in better times. And the other thing is related to these other two strands of literature. It can potentially help us understand how policies that are restricting credit mitigate the consequences of household leverage at the micro level. So get some new insights into potentially a supply channel, and also see better how the household balance sheet affects the economy through job search. Okay, so this is a short presentation, so I'm just going to give you the results, and then I'm going to see how much time there is to go through the different parts of the paper. But we find that introducing this LTV constraint, loan-to-value constraint in Norway, leads to a reduction in household leverage, and actually improves wages. So the introduction of this LTV constraint, I'll tell you more about that later on, it's an 85% LTV constraint, leads to a 25% decline in the debt-to-income ratio, and it improves wages of workers by 3.3 percentage points. Now, how does this happen? Well, as we find, and I'll show you later, lower leverage seems to enable workers to search longer for jobs when they become unemployed. And these displaced workers who search longer for jobs when they have lower debt end up finding jobs at firms that pay better wages for equal quality of workers. These displaced workers with lower leverage are also more likely to take jobs sort of in a new occupational category. So they're becoming more mobile in terms of what kind of jobs they take, and they also become more mobile in terms of industries in which they work. So I'll show you later on that there's about a 20 percentage point increase in industry mobility of workers. Now, one result that I want to stress here, I'll get back to that later on, is a thing that I find really interesting and important, is that sort of in the social debate or in the professional debate about macroprudential policy, one of the things that comes up often is that these policies may be good to improve financial stability, but they hit particular people in society really hard. Young people have not had a lot of time to save money, and so when you force them to make a down payment, they're more likely to be locked out of the housing market, or they're more likely to be, to have to move to kind of housing where they otherwise wouldn't be living. And what we find is that actually, much of our results is being driven particularly by young workers and workers who have had shorter tenure in their jobs. And this effect is also stronger than for more educated workers. And the logic here can be sort of twofold. One is, when you're younger, you have a long career ahead of you, and the benefits of actually doing better job search are going to be higher than, let's say, for somebody like me. And when you're better educated, you're probably better able to adjust to new working conditions. So if you're going to take a new occupation, or take a job in a new sector, then having high education or having an ability to learn is probably going to help you as well. So I think, for me at least, one important takeaway from the project is that when we think about the costs and benefits of macroprudential policy, there seem to be side effects of macroprudential policy that are really good for the people, probably also hit a little bit on the negative side. And that could be important in both communicating about macroprudential policy, but at least to me, it also speaks to some of the things that we may be thinking about intuitively, that people having high debt, it's not always great. I mean, it allows you to buy a house, but there may be other side effects. And I think what we try to do is sort of, pinpoint to one of these positive effects of restraining debt. Okay, I'm going to have to speed up a little bit, but so what are the key ingredients to the paper? Well, actually, if you look at theory, there are two kind of strands of papers. There's one group of papers that argues that when household leverage increases, household leverage tends to increase wages. And that is because debt creates kind of a debt overhang effect at the household level. The argument here is that when you have a lot of debt, the payoff for you privately when you find a better job becomes lower because you're basically spending most of your money repaying your loans. And so this is a paper by Donaldson and Takor in the JF from a couple of years back. They argue then that when households have high debt, firms will have to offer higher wages to get people to take jobs. And that then leads to higher wages. I personally find that not super appealing, that argument, but I understand where they come from. For me, more intuitively, there is this literature that argues that household leverage tends to decrease wages. And here the mechanism is basically comes from liquidity. When you have a lot of debt, you have your debts to pay, you lose your job, you're stressed about repaying your mortgage, you don't want to get a default because then you end up in a credit register and it's going to take you out of the credit markets for quite a while. So this leads to people typically taking job offers quicker rather than slower, and therefore they might get a worse job match. And there is actually there's at least one really interesting paper by G in the Journal of Monetary Economics that finds for college graduates that have very strict terms on the study loans, that they tend to take job offers much faster, and that this actually has really persistent effects on their wage evolution later on in their career. Anyway, from our perspective, given that there are two literatures, which way is it going to go? It's kind of an empirical question and not only a theoretical question. So there are two challenges, basically, if you want to investigate this question. One is, if you want to understand the causal effect of household leverage on labor market outcomes, you need some exogenous variation in household leverage. Secondly, what you want is that you want job search by households that are not triggered by their individual characteristics. You want some exogenously driven job search. And that's what we're going to try to do here. So we have three key ingredients. One is this introduction of the LTV constraint, which is a policy that's exogenous to the households, and that's going to reduce leverage. The second ingredient is we're going to have displaced workers who recently bought a house. And I'll say a little bit more about that in one of the next slides. And then we use very granular data on the labor market. The balance sheet of households comes from Norwegian tax filings, and we use housing transaction data, so we can observe exactly when people buy a house. Okay, the LTV constraint then. It's an 85% cap. I'm going to restrain myself a little bit as well. And that leads to some households having smaller mortgages because of the introduction of the policy. I'll get back to that later on. Here is something important about the displaced workers. So what we want to avoid in doing this empirical analysis is that we don't want workers to start searching for jobs because of their personal characteristics. So why is that? Well, suppose that less able workers end up searching for jobs more often, then we might have an overrepresentation of workers with low ability, and we might not find that reducing debt is actually creating any particular benefit. So what we're going to do here is that we're going to limit ourselves to workers who were laid off in so-called mass layoffs. Mass layoffs have been sort of used in the literature before, and they're typically defined as, when does a firm reduce its staffing by 30% of all employees in a particular year, or just stops existing at all. Basically this means that a firm lays off workers, and it's not because you're bad, it's just because the firm is not performing and needs to get rid of its staffing. So we think this is the best way to find workers that start job search for factors not related to their own background. Okay. And then finally, there's one more restriction that we need to place on the data, is that we do this study for a period in which house prices were rising. Now, if you buy a house and then we would wait very long for observing you, you might be building up home equity because the value of your house is rising in this period. So we're going to impose another constraint and say we're only going to take workers who buy a house and then lose their job within 12 months after buying the house. And that means that the scope for building up substantial home equity is small. And why is that important? Because if you have home equity and you lose your job, you might be able to borrow against that home equity, or you might be able to sell off your house, for example. And we don't want that. That would be potentially biasing our results. Okay. So I'm going to take this really quickly, but the essence here is one of the disadvantages of LTV constraints is they apply to everybody. So everybody is in principle affected by the policy. So we need to determine which workers are more likely and which workers are less likely to be affected by the policy. And we're basically going to be doing that by running a model that predicts whether you are likely to be constrained or not. And we do that by using the data before the introduction of the policy. So basically, we're going to look at people who bought a house before the introduction of the borrowing constraint and say which people were choosing LTVs above 85% and which people were taking LTVs below 85%. And then we're going to use this model to predict in the post period which people would have been likely to take an LTV over 85% and who would likely have taken an LTV below 85%. Now, for the sake of time, I'm going to have to leave it here, but What's important to know is that we use a random forest algorithm to do this. It's non-parametric, so that gives us some safety about potential biases. It is very powerful. So for the sake of the people online, it says here that we correctly classify 82% of the pre-policy observations. So it has very good predictive properties. Okay. Let me just start moving on to the results then. So we're going to run a standard difference in difference regression where we're going to be comparing households who are likely to have an LTV of more than 85% without the policy with households who would have been likely to have an LTV below 85% without the introduction of the policy, and compare them before and after the introduction of the policy. It's just going to be a standard difference in difference regression. What is important here to keep in mind is that we're going to measure debt at the household level and not at the individual level, because many people live together with somebody else, and the bank will measure your LTV constraint relative, or LTV and other borrowing constraints in terms of credit by the full household and not only by your share. But when we look at outcome variables, we're going to be looking at the outcome variables of one individual, the person who loses the job. Okay. I do want to show you a couple of results, and time is moving fast. So one important thing is, are there parallel trends before the introduction of the policy? Here we basically, if you look at the graph and look at the first 4 dots, you basically see that the treatment and the control group were on the same path before the introduction of the policy, and that's what we need to do our empirical analysis. So this is sort of a quick sanity check. Now, let me run through a couple of the most important results. One is, does the introduction of an LTV constraint lead to a reduction of debt? And this table says yes. So if you look at the coefficient in the upper part of the table, you see these coefficients that range from 1.09 on the left-hand side to minus 107 on the right-hand side. That basically means that the debt-to-income ratio after introduction of the LTV constraint falls by approximately 1 time your annual income. So it's a significant effect, and it boils down to approximately 25% reduction in your debt-to-income ratio. Sorry. Okay, then let's go to wages then. Given that we have established that wages are going down, that debt goes down, what happens to wages? Well, we see here that wages go up by about, so the coefficient here, 0.335, says that wages of workers who are forced to restrict their leverage are about 1/3 higher than of workers who are not forced to restrain their leverage. And if we move out and introduce more fixed effects, we see that this effect almost rises to about half. Now, what does that coefficient mean? Well, workers who lose their jobs and find a new job always get lower wages, or always, on average, get lower wages in their new job. That's just a phenomenon in labor markets. So the coefficient of about 0.50 means that if you look at the lower part of the table here, the average worker who loses a job gets a 7.4% lower wage in the next job. Workers who are forced to limit leverage are able to compensate about half of that. So they get about a 3.5 to 3.7% higher wage in their new job. Okay, I'm going to have to move fast here, otherwise I'm going over my time constraint. So that's important. So remember that they get better wages, but they don't get high wages. They still get a reduction in wages, but the reduction in wages ends up being smaller when they have lower debt. Okay. Now the question is, I'm going to skip the robustness test here because I want to tell you something about the mechanism. There are 3 potential ways mechanisms through which wages could go up. Workers could extend their unemployment spells to extend surge. It could also be that workers, when they have lower mortgages, they're actually able to borrow more when they become unemployed. So there could be a credit market effect. Or it could be that workers find jobs at new employers that pay better better wage premium. And actually what we find is that there are two factors going on here. The duration of the unemployment spell goes up, so workers search longer for jobs, and when they search longer for jobs, they find jobs, and you see that in the last column here, they find jobs at firms that pay higher wage premium. So to equal quality workers, they pay on average about 5.8% higher wages. What's important here is it's not driven by credit markets. So there is a discussion in the literature whether better access to credit would affect labor market outcomes. We don't find any such evidence. No. Okay, let's move then to another part of the mechanism. How do workers get these better salaries at these other firms? Well, they become more mobile, so they take jobs with new occupations. You see here in column 2, these workers who are forced to restrict leverage are 29% more likely to take a different occupation, and they're 23% more likely to take a job in a different industry. They don't become geographically more mobile. So it's really like a job, a sectoral change that takes place. Now, maybe the last important result here is, when workers take different kind of jobs, we could think, oh, they take jobs with high wages, but these jobs are actually quite risky. So they get higher wages, but they also get laid off, or they get a high volatility of their income. It's not the case. So workers actually have lower wage volatility after the introduction of this policy. So they get higher wages and they become more certain. Okay, I'm just going to repeat what I said before. I think this result that young workers and highly educated workers benefit the most of it is a very interesting angle. If you're interested in looking more at it, you can look at the tables in the paper. Let me just summarize here. Household leverage affects labor market outcomes through its influence on job search. The reduction in household leverage leads to an improvement of wages and workers, and this happens because workers have longer spells between jobs. And when they have these longer spells, they find jobs in better paying firms and they broaden their job search. This effect is not, as I mentioned, is not associated with the rise in income volatility or job risk. And I think an interesting interpretation of the results is that macroprudential policies that limit household leverage can thus have not only negative, but also positive side effects in the labor market. And these apply particularly to young people with short job tenure. If we think about the current state of the economy, I think, where many countries probably face households with high levels of leverage, it could be important to understand, what might work, what would happen to these workers if we would be able to restrain their leverage, and would this be bad? Would this be good for workers' wage development in the future? Okay, thank you.
Thank you, Kasper, and there's some minutes for discussion. Any questions?
Hello. Thank you very much. Very interesting presentation. I have one comment and one question, if I may. So first of all, this reminds me about one paper that I've seen by Meneke Hampol. She's looking at how financial constraint affects the choices of occupations by young people in terms of comparing the earnings in the early stage of the career versus the further stage of the career. And she shows that those who are financially constrained, they choose the jobs that start paying high from the beginning, but have a flat level later. Okay. They do not grow. And those who are less financially constrained, they choose jobs that have a steeper growth in the career, but low starting wage. So this would be like a question whether or not you can also look at the profiles of the career paths in different occupations here. And the second question, or maybe that question, is about what you look at people who lose the job within 1 year, and I totally understand why. I think it's fully justified. The question is, can you show that these people are similar to the rest of the samples of people who lose the job, so that whether or not there are some important personal characteristics that can be different, and if not, then maybe this is an estimate from below or from above, and you can also say that. Thank you.
Sure. Is it okay if I answer the question directly? I have a really bad memory, and I didn't make any notes. So but regarding your question about the features of these people, so we look at at whether the policy changes the composition of the pool, for example, and it's not. People who are treated and are not treated, they are different. The important thing, of course, for the identification here is that they are on parallel trends. So there are differences, but the policy doesn't lead to a change in composition or any change in the relationship between the features of these treated and non-treated workers. And regarding your first comment, it would actually be great if you could give me that reference, because I'm actually not aware of that paper.
Thank you very much. I also see this is a very interesting paper with very interesting results. Is the type of thing that one could get nothing and you get lots of very interesting effects. I've been trying to understand the mechanisms in terms of the incentives of the different individuals under the two possible situations. No, the situation in which you have a lot of mortgage debt to pay back, and the situation in which, due to the LTV being binding, you didn't get into that situation. But I guess these individuals want to be able to accumulate enough, quick enough, for a down payment and eventually buy a house. That's my introspective reading of what is going on. So I connect your results to the idea that when there is a binding constraint, and in a sense the new LTV limit is a binding constraint in the optimization of those who would like to buy the house, you have incentives to enter lotteries to get rid of the constraint. So in a sense, spending longer trying to find a much better paid job is a form of a lottery. So it's a form of risk-taking that could be incentivized by the binding constraint. If you already had your house and your debt, then you will maybe in the opposite direction fight for not defaulting on that debt, which to me looks a more plausible story than the debt overhang story. Depending, on the other hand, depending on whether there is limited liability or not. I think that for debt overhang story to fly, you need limited liability. I don't know what is the situation in Norway, but at least
there's
in
no
Spain,
limited liability.
With with recourse mortgages, people will do everything they can not to default on the mortgage, not to see their property foreclosed and the debt remaining. So that will explain a much more conservative attitude by those who have to pay their mortgages and therefore will have to accept the first job coming and cannot gamble for a better wage. So that would be my interpretation of this very interesting result.
I took that as a comment and not as a question.
So thank you again, Kasper. And
thank you very much.
I'm afraid we have to continue. Of course. If there are no other very quick questions. So please join me once again to give a big hand to Kasper. And we continue our Nordic session with another very interesting presentation by Rikke, Rhode, Nissen from Danmarks Nationalbank on borrower-based on the effects of borrower-based regulation on housing demand. So whenever you are ready, please, Rikke, the floor is yours.
Thank you very much, and thank you to the organizers, and thank you for having me here. I should start by the usual disclaimer that this work reflects the view of me and the authors and not necessarily the view of Danmarks Nationalbank. So we've done this paper about the effect from borrower-based measures on housing demand. So a little about the motivation for this project is that we understand some of the direct implication of these measures limited the credit liabilities, but only very little is known about how this regulation actually affects the housing demand and how household will react and substitute between these housing units based on these new budget constraints. So what we try to do in this project is that we try to quantify what is the immediate effect and what is the behavioral effect on housing demand of different hypothetical policies that tightening the borrowing conditions across different residential housing units in Denmark. So we do two things. First of all, we want to look at what are the direct implications of introducing stricter regulation. So we want to know who will be affected in case we tighten regulation, who will be affected by this tighter regulation. In the next step, we want to show what are the substitution effects. That is, we want to see those people who will not have been able to purchase this house, what would they do instead? So, in one word or one sentence, we just want to examine who would not have been able to buy their house under these new conditions and what would they do instead. And I will just jump straight to the conclusions. So first of all, we find that in case of tightening the LTV, loan to value, we find that across the entire country, a lot of households will be affected. On the other hand, we find that tightening DTI, the debt to income ratio, that will mainly affect households in the biggest cities and especially in the capital region. We also find, because of this, that tightening DTI especially creates a negative demand shock driven by some are not purchasing at all and other people are just postponing their purchase. And at least we have what I would say the most interesting result is that we find that these substitution effects counteract the direct effect in the capital region. So that is, we find that DTI requirements affect most people in the capital region, but on the other hand, people have so strong preferences for living inside the capital region that they will just substitute to other, to smaller housing units. Just a little about the data we use. We use housing transaction for 2 years, 2017 and 2018. And together with that, we have information about the household on individual level. So we know about their income and other financial information. And we also know about their specific loan and how much they pay to their loans. So we see here a map of Denmark. So this map shows how, in case we tighten in case we tighten LTV from the normal constraint right now on 95%, we tighten it to 90%. How will people be affected across country? So this color scale ranges from the gray is the least will be affected, and the red color is more people will be affected. So we see that the red color is spread over most of the country. Maybe I should mention here that we have like somehow complex regulation on the housing market in Denmark. So the only strict regulation we have is that we have this LTV requirement on 95%, and then we have a more complex system using DTI and DSTI regulation. To compare how LTV and DTI affect households, we have tried to do the same exercise, but try to restrict DTI at the level of 350%. And we see here that the restriction is highly concentrated around the capital region and around Aarhus, that is the second largest city in Denmark. So also I should mention that we have calibrated these numbers. So we took our starting point at the LTV limiting from 95 to 90%. That means around 16% of the actual housing buyers would not have been able to do this housing purchase. And we tried to calibrate this number so that it affects around the same number in case we restrict the DTI regulation. And this is how we can kind of compare the two different kinds of regulations. I should say that we have also done other things, but I'm not going to show them here because we also need to have time to talk more about the next step. But we also compare across different financial information of the households. So now we know that how household, at least geographically, will be affected by introducing tighter regulation. So we had a period, like most European countries, had a period where house prices have been going up for a long period. And if you're a regulator, you could look at the map to the right here and say, okay, if we want prices to be a little more flat, at least in the largest city, maybe we could do something about the DTI regulation. That would be obvious from this map. But first, we need to figure out these people who would not have been able to buy under the new regulation, what would they do instead? Before we go too far, we will group the different housing units into these so-called segments. So the point about the segments is that we want to group similar houses or similar house types in these segments. So we have in total 4 different splits. We do a split on the 5 different house types. We have small, large apartments, large, small single-family homes, and then we have the terraced houses. And then we have 3 different geographical splits. We have 5 regions in Denmark. Then we have 3 types of municipality, whether it's urban, suburban, or rural areas. And then we have 2 types of zones that is within each municipality. Is this house located within a city or is it located on the countryside? Limiting that we want at least 100 transactions in each of the segments, we end up with 91 segments. So now that we have these segments, we want to model what are the household's preferences for each of these segments. The easy way to do this would be, okay, we know the household and we know about the previous segment, so we can just make a model based on the previous segment and use that to predict where will they go next, what are their preferences for the next segment. There is at least one big issue with this. We have a lot of the housing buyers are new buyers, so we don't have information about the previous segment. Therefore, we need other types of information to predict for the young households where will they go. So what we do is that we use a machine learning model, and we give this model a lot of input. So we have access to a lot of input or data about the households, and we use this. For each of the households, we know the level of their education, we know their job description, we know about where their workplace is located, we also know where they were located before the purchase, and we know something about their family characteristics, how big are the family, how old are they, and how many children have they. Then we have the financial information about income, about wealth, and then of course we have, in some cases, information about the previous housing unit. What we do simply is just take all this data, toss it into the machine, and the machine gives us the target value, and the target value is just a prediction or it's just a probability for each of the 91 segments. So I try to illustrate this in the bottom of the slide. Just a very simple illustration is that we have 2 different households, and we have, in this case, only 3 different segments, and we see that these households have different probabilities, or what we interpret as preferences for each of the segments. So the great question is here, how good is the model? The model is not supposed to predict the actual segment that the household is buying in, but it's supposed to predict preferences. So in case that a household likes 2 segments equally, it should be like 50-50. So when we want to evaluate how good this model is, we use a top 5 accuracy. So we say the segment in which they actually bought is that among the top 5 segments with the highest probability. And we find that in 89% of the cases, we have this. So this is actually quite a good accuracy that we have. Just for comparison, if we have done the easy model, only using the segment of the previous housing unit, we would get a top 5 accuracy at 0.33. So, yes. So just to give you a little intuition about what this model actually predicts, I have 2 different examples. So as I mentioned before, if we were just having the simple model only with the previous housing unit, then we will have a lot of young people where we don't have information about their previous housing unit. So in this case, I've tried to make this diagram where we on the left-hand side see the previous housing unit, and on the right-hand side, we see the predicted segment. So this is only on the housing type, because I didn't want to make it too complicated to read. So this example is just a young single family, and we see in most of the cases we don't have information about the previous housing unit, probably because they were just moving away from home, or they came from rental market. Then we find that in most cases, the young single household, they would either buy a small apartment or they would buy a small single family house. That depends on, are you in the city or are you out on the country? I should also mention that, of course, these preferences are conditional on the current regulation. So otherwise, I guess that most people would require a big villa or something like that. And just to have another example, here I selected a family of 2 with 2 children. And we see, first of all, that a lot more is in the housing market previously. But we see the flows that most people would prefer either the small single family home or the large single family home. So I think that these 2 examples give a little more about the intuition about the model, that the model is actually able to distinguish between different kind of households and how they have preferences for different kind of housing. So, now we are almost ready to go to the further results. I should say now that I will only focus on the results for the DTI, because I think that those are the most interesting results. We have done the same calculation for the LTV. You can read that in the paper. So what we know also now is that we have about these 16% who will be restricted due to this hypothetical regulation. Then is the question, this household, what would they do if they had not been able to buy? Here we make one assumption. So we make the assumption that not all people will decide still to buy a housing unit. We have the assumption that 20% of those who are restricted, they will decide not to buy or to postpone their buying. Then we have the remaining 80%, and these people will still, we will allow them to substitute into different housing units. So by this, we are actually able to measure the net effect of this different kind of regulation. And I brought another example. So I just told you that we have this, that 20% of those who are restricted would not be able to, or decides not to buy. That means that in areas where relatively more people are restricted, so for instance in the capital region, more people, it will automatically lower demands in this area. So I have here 3 different segments. I have first of all, the large and the small apartments in Copenhagen, in the city center, and then I have just a normal house in the suburbs. So we see here that what is the direct effect of tightening regulation? We see that demand for apartments in Copenhagen will be directly affected negatively. On the other hand, we use these preferences, and we use it, of course, scaled relative to the new budget constraint. And then we find that this have 2 opposite effects on the demand. So first of all, if we look at the large apartment, we see this large negative substitution effect. That is, we have first of all the direct effect from people not buying, and then we have the effect that a lot of people will not be able to purchase in the large apartment segment any longer. So what these people do is that they either have preference for living in Copenhagen, so they substitute to the smaller apartments, which actually counteracts the negative effect from introducing these restrictions. They might have preferences for having a larger space to live in, and then they will move outside of the city. So maybe some of you know this game about the moles. When you knock the mole, it will just jump up somewhere else. And that is a bit what we see here. And I also think that, back to the map we saw earlier, that this is very interesting, that if you want to limit the house prices in the capital region, it could be obvious to do something about the DTI regulation. But as we see here, we just force demand from the large apartment down into the smaller apartment, actually leaving the demand for the small apartments in Copenhagen completely no effect. So this is, I should also mention that we only look at demand. We do not look at what is the effect of prices, but we know, of course, that these 2 things are very correlated. So just to sum up, we find that tightening the LTV requirement has more broader effect across the country, while the effect of DTI primarily affects within the largest city. Then number 2, we find that tightening, especially DTI, will create a large shock that is mainly driven by some not buying or postponing their actually purchase. And at least we find that this substitution effect actually counteracts the negative effect by pushing the demand from the cities or into either smaller housing units or into the suburbs. So, in case you want to know more, of course, you're very welcome to ask questions. Otherwise, you can download the paper. But I think that's it.
Thank you, Rikke. Questions or comments?
Thanks. Really interesting. I have one question. I mean, you mentioned you don't look at the house price effect, but do you look at what happens to rental markets?
No, we don't use. We don't look at the rental market. We only look at what would be the expected effect on demand.
Because it would, would be interesting to understand better, if more people stay in the rental market, there might be other adverse effects for that group of people that we don't capture by looking at the housing market.
Yeah, I agree.
Thanks.
Thanks a lot, Rikke. Actually, I wanted to know the data. Do you have it available, let's say, one-off basis, or would you have this type of data also available for when you're making macroprudential decisions? And the second thing is, can you say more about this AI method that you used? If you can explain anything more, would be interesting. Thank you.
Yeah, so we have access to a lot of different data, and we can also use it for policy recommendations. So that is a very big strength. We actually got the credit register only a few years ago, but it provides very detailed information on loan level for each individual. So we are really able to manage and look at a lot of things there. About the machine learning model, I can say I can say some at least. So we use this decision tree model that is, so it's called a histogram-based tree model. So it makes like a decision tree to predict what is the actual outcome. And I've actually, so I tried to explain this to my parents, and I wanted to, how do I explain it? So if we say that I have 4 fingers and I want to detect this finger from the other 4, then I make the first decision tree is to say whether it's on this side, so make a line, whether it's on this side or this side of the line. So that is the first thing I do. So I find out that, okay, my point is on this side of the line. Then I use the error from that prediction to say, okay, I know that this is somehow true, but I can be more precise. So I make another tree based on this prediction error to say that, okay, if I put another line here, then I will actually be able to use those 2 lines to perfectly detect that finger in the middle. Excuse me?
Is not this a finite mixture model?
No.
Would it change a lot if you would change the 80-20 assumption you had in the middle there between what's happening?
I tried to do some robustness check, and it was still the same results, or kind of the same results we came out with. So
that was a good test.
Yeah.
Any other questions?
Thank you for an interesting presentation. I was just wondering on a very sort of qualitative level, like, because what you show is very interesting, that there is a very different response to an LTV and a DTI restriction. Like, qualitatively, why is there such a difference?
So I have some backup slides. So if we just look at which kind of household will be affected by the different kind of regulation, here I have also the DSTI, but that is kind of similar to the DTI. So the household that are restricted by LTV is very different from those who are restricted by DTI. And if I should come with a guess, then it could be that those who are restricted by DTI regulation are very concentrated in the largest cities, and it's possibly people with higher income, of course, and also people that might have, they have higher income and therefore jobs that require them to stay in the city, and therefore they might also have stronger preferences for being in the city compared to those who are restricted by LTV.
Thank you.
Still a quick question or two. If not, please join me once again to thank Rikke. Thanks. And now it's the best time of the day. It's a lunch hour. We have lunch in the room next door, and you have the opportunity to learn from the poster sessions in the room next to the lunchroom. So we will reconvene here at 1 o'clock. Thank you very much.
Okay. Thank you for coming back. Now it's time for our last keynote speaker. And this is, I don't know how to say this, Michael Platzer. Sorry if this is... Okay. And Dr. Platzer is a co-founder and chief strategist of Mostly AI, a global leader in generation of structured synthetic data, a little bit that we touched upon yesterday. I would have liked that it would be more, but maybe we get more about that in a bit. Prior to that, he worked as a lead data scientist at Nokia and Microsoft, earned degrees in applied mathematics and business, where he contributed with his award-winning PhD to the field of behavioral simulations. But we're really glad to have you here, and I will just give a note that the break after his speak is postponed, so we will, after Michael's keynote, we will go directly to session 7. And then take the break after session 7 at 15:00. But without further, and then I forgot to say yesterday we had more than 100 participants online. So there were more participants online than on site, but I'm very happy for both the online participants and the on-site participants. But now, without further ado, thank you, Michael. The floor is yours.
Thank you. Yes, thanks a lot for the invitation to talk about synthetic data. I was very positively surprised that you have proactively reached out to me and specifically wanted to learn about synthetic data. I know quite a bit about it because I started 6 years ago a company just around synthetic data. And back then, no one wanted to talk to me. They all thought it's totally crazy to fake some data and use it actually for analytics. So times have changed, but I have to give in to my terrible imposture syndrome and admit that I know nothing about systemic risk analytics. I had to ask ChatGPT what this is about, but I think I'm all set and I see the connections, and I want to invite you on a journey to discover synthetic data and then together explore what these new opportunities can bring to your field. Still, the title of the talk is about AI-generated synthetic data, a new lingua franca to unite for systemic risk analytics. So here's the big data dilemma. There's 3 components to it. On the one hand, the algorithms dominate. And this was kind of funny and entertaining while we watched that the algorithms get better in chess and that they beat the Go players and in poker, and they are really good in movie recommendations and song recommendations, but they get better and better, and they get creative, and they outperform even the top experts in the field of human expertise by a far margin. And they can scale better, they are more efficient, they are faster learnings, and they will influence more and more of the decisions of our daily lives. So what is also changing is that the decisions that are being made that are based on the algorithms have a much more profound, a deeper impact on individuals' lives. And suddenly this is getting more serious. This is not just about getting the next Netflix movie being recommended, but actually whether I now get the loan or whether we are able to simulate the next pandemic and treat and fight the next pandemic right. So with that rise in significance, we need to think hard about regulating this new powerful tool, because there's a severe risk attached to it. I'm an AI optimist. Part of my brain is also an AI pessimist, so not quite in the doomsday sector, but there's certainly a serious risk that is attached to introducing more and more algorithms and automating more and more of the decision processes at scale, in particularly if we don't fully understand the logic that is behind these algorithms. The next component of our dilemma is that financial data, so personal data in general and financial data in specific, is very sensitive. So it is hard to actually get access to personal data. And that for a good reason, because this is our privacy, these are our secrets that we don't want to be exposed to everyone else out there. So we want to be cautious in our decisions in what type of information about us individually we want to share and what not. And for a good reason, therefore, Europe is at the forefront with the GDPR and being the leader in terms of data protection. And this is not going to go away. It is actually being adopted worldwide by various nations, and they take the GDPR as they try to copy many of the elements that were introduced by the GDPR. But it's interestingly that the finance sector, I found, has not fundamentally changed due to the GDPR. It was data protection was always deeply part of the DNA of the financial industry. For hundreds of years, they were earning the trust of the customers by being secretive about their money that they have deposited, about the transactions that they are making. So they're taking zero risk in exposing that data to any externals and also internals. So bank level security is a known term for a reason. There's no one as strict and as paranoid about the sensitivity of the data as the finance sector. So this is a particular challenging problem. Then how can you get access actually to the data? And thirdly, I would like to throw that one in, and that is an increase in the global interdependence. That is, the world is increasingly connected, and it makes it a difference now whether there is a weather phenomena in South America, or whether the dam breaks in the Ukraine, or whether there is a flu outbreak in China or a housing crisis in the US. All of these things are increasingly interdependent, and we need to collaborate actually globally in order to be able to fight, or in order to be able to find solutions. No individual person, no individual country in isolation will be able to tackle all of these upcoming challenges all at the same time. So all three of those put together, they kind of pose a dilemma, a conflict. Like, how can we solve that? How can we humans stay in control of the AI if the data that is fed into the AI is restricted, if the data that we feed that is restricted cannot be shared globally? How are we able to collaborate and reason around all of these challenges? So since you all have a background in economics, I tried to not use an emoji, I use a demand and supply curve. And that is also, you can term this as the data oil crisis. So data is the new oil, and so there is a crisis going on. There's an increase in demand driven by AI, driven by analytics, and also the need for governance around AI to get more access to data. The appetite for data, and for granular level data in particular, is increasing. And on the other hand, there is an increased level of understanding about the sensitivity and the problems attached to the data. So that is driven by regulation, by the risk, as well as by ethical considerations. They restrict the availability of data. And somewhere there, and those are two major forces competing against each other. And the time trend is kind of clear. So somewhere here on the x-axis we are, and the gap is widening. The question is kind of, are we rather here on the left or rather here on the right? But the data protection is not going to go away. The appetite for data is not going to go away. So those two forces are in existence, and they compete against each other. Now, the title of the talk was Synthetic Data, the New Lingua Franca. Now, data itself is certainly not the new lingua franca, it's the old lingua franca. And who in the audience has seen this map before? So there's one gentleman over there, and this is a famous visualization by John Snow, who was a physicist that discovered the relationship between the cholera outbreak and the water pump in London. And he did. So he was driven by the intuition around it, but he was observing that there is a correlation between the neighborhoods of the people dying of cholera in London, and he plotted all of those on a map. So this is personal data. It was kind of privacy sensitive. Well, the people died, so probably they didn't complain anymore. So no GDPR in place, but he was able to put that on a map, and he was able to convey the idea to the decision makers to remove the handlebar from that water pump. And for everyone, this was kind of like, at that point, it was not clear that cholera was transmitted via bacteria. It was not even clear that there was any correlation. So it sounded like a witch doctor now coming along. And no, he was able, with this visualization, to convince the authorities to remove the handlebar of the water pump. And with that, he was able to, on the one hand, control the outbreak of cholera. On the other hand, it was the beginning of starting to understand that the bacteria and the germs are relevant for the disease, for the pandemics. Now, this was a long time ago, and of course the world has advanced, but it was also back then, it was data that helped to convey a message, not just to the data scientists, but to everyone, to the decision makers, to the policy makers. Now, fast forward, we have seen plenty of these visualizations as part of the pandemic outbreak. So this is just a random one. This is showing the infection rates across various countries over time, the number of days since the days since average daily deaths passed, plotted across different countries. Everyone can look at it and can get a feeling and an understanding of how the dynamics of such a pandemic behaves, and where you as your own country are on that curve, and whether your country follows the same pattern, maybe you want to learn from the other countries. So this helped a lot. And I've never seen as many charts and visualizations in the newspapers as during the pandemic. So it was a crash course on data literacy, which was great. So there was more and more data actually available, but this is kind of infotainment. This is not the type of data that was used to combat the pandemic. This is aggregated, very high level count statistics that were used to, well, understand the dynamics, but in order to really understand, like, who were the people actually being infected, who were the people that died, who were the people that spread it, what was their social interactions, what was their mobility patterns, does it help whether we do intervention A or B? So all of these deeper questions require a different type of data, and that is microdata. So granular level data that is around the individual person. So let's say, and now this is switching back from the medical field towards the finance again, let's say this is data on the individual loan taker. Jeff Hulse is his name. Probably the name does not matter much, right? But maybe the age matters. His monthly salary matters, the amount of unpaid principal matters, the interest rate, the location, the loan details, the property details, the household details, whether he has other loans, what's his nationality, his education, his profession, his running costs, and 1,000 other data points that you're potentially interested at the granular level. And all of the data is actually available through digitalization. It's not, it's a byproduct of digitalizing services. All of this data is available. Not just for a single person, but for millions of people. So there's a gigantic amount of data, and that is the true explosion in the data volumes. The global population annually grows by 1%. The data volumes grow, I don't know, by 30%, 50%. So it is the data points, the number of data points per individual that is exploding. So we get richer and richer information at an individual level. And ideally, we could all benefit from all of this data. So we want to share that data with millions of people so that we can make smart and more informed decisions, that we can do science and policies on top of this data. And I did my best with getting creative with all the emojis out there, showing that data is not just for the data scientist that sits on the computer. No, data is for everyone in the population in order to understand and reason around what's going on. So we need this transparency, we need this open access to the data. whether you are a teacher, whether you are a detective, a superhero, whether you are in the government or part of Bank of Finland, or whatever emoji you pick up there and you identify yourself with, or you are actually enabling a machine to learn from the data, right? So they all need access to the data to learn from the actual behavior. Now, here's the dilemma, and it's the same dilemma that I mentioned before. You don't get access to this. Like, this sounds very appealing, but you're not going to get access to that. Well, except, of course, you get your exception, and if you're really fighting hard, you will get privileged access in a secure data room, but then you just get the data, not your colleagues and not the other colleagues from Italy, and you don't get the data from Finland because that's sensitive, so we don't trust you, so you cannot share, you cannot collaborate on top of the data, on top of your research, on top of your models that you're all validating. So this microdata that could be the new lingua franca is not accessible. So life would be easy if we could just anonymize data. So let's do this. So that is me. I think you were able to re-identify me. I've grown a bit older, less hair, but that's still me. And that would be useful. So let's say the data point is a picture of myself. So you want to learn something. You want to learn how faces look like. So you can take a picture of me and then, okay, good, you learn something. But I'm not giving you now the picture. This is private photo. So let's anonymize it. Do we have any suggestions in the audience how to anonymize this picture? Any suggestion? Change the colors of the eyes. Okay, yeah, that could work, but I think you would still be able to identify me. And particularly, this is black and white, so this doesn't work so well. But I could. Okay, I will help you. Let's say we will do this. Okay, perfect, job done, right? So that's anonymized. We can go home. Everyone is safe. No one got hurt. I hope if I ever commit a crime and they put a photo like this in the newspaper and they just mask out my eyes, I will talk to my lawyer. Of course, this is not private information, right? So everyone can re-identify me. It's just like wearing sunglasses. So we have to go further. We have to mask more. Now, okay, that is, maybe you will have now a hard time to re-identify me. My wife for sure will re-identify me, whatever it takes. She will even re-identify me at this stage, just, I don't know, based on my hair up there, so whatever it takes. The machines, the AI that are trained to re-identify people and faces, they have no issue at all to re-identify even at this stage. Whatever you leave intact, and it looks so innocuous, and for us humans, it might be impossible to re-identify. For a machine, this is a trivial task by now, to re-identify individuals based on some characteristics that is able to extract it, even though the machine has never been trained on pictures of myself, just of other random people, and it has learned what are the characteristic patterns, and then it can do pattern matching and re-identify me. So we have to go further, and maybe at this stage we are happy, right? So now we have protected the data. Well, we can't be 100% sure because maybe we still have left something in there, but you get the point, we need to go all the way, right? Okay, now we are done, we can go home. We have successfully anonymized the data, but this is of course super private but totally useless data. And this fundamental trade-off between the utility and the privacy has always existed, so that there's nothing fundamentally new actually there. What is changing is that the problem of anonymization is getting exponentially more difficult the more data points you have per individual. So all the classic anonymization techniques that are based on obfuscation, suppressing, and masking are based on an assumption that you have 5 attributes, 8 attributes, and that's kind of the maximum, right? Because then you're already highly unique and re-identifiable. But if you have hundreds of attributes, there's no way that you can get away. And I tried to also get more creative in some other obfuscation techniques. So like there's always this trade-off. You can be creative as much. This is still Michael Platzer, and this is still re-identifiable unless you get to the point where you don't recognize anything at all anymore in the data. So classic anonymization does not work, and I'm not the only one out there that is telling this. This has successfully escaped the academic world and is mainstream news, and it's clear to everyone. It should be clear to everyone that classic anonymization does not work at the micro level. Yes, you can always aggregate, you can go back to the counting statistics, and with that kind of discard 99% of your actual information in the data. So you need to make the decisions on how you slice and dice and aggregate the data. Yes, that's possible, but at the micro level, you cannot anonymize. There are tons of leaks and stories behind that. So one of them was the famous Netflix case, where Netflix did a competition. They released movie ratings completely on user IDs. So there was no socio-demographic information at all attached to that. So you just had an ID 1, 2, 3, 4, but you knew at which date what movie was watched and what rating it got. And with that, they were able to, within 2 days after the data was released, and Netflix thought this is a clever idea, they're going to do a competition. After 2 days, the researchers showed them, well, sorry to tell you, we found 1,000 people by triangulate a public website and figuring the same dates that someone watched and commented and reviewed, someone here with the information in your database, and we could figure out what were all the other movies that they watched on Netflix, like the complete Netflix watching history of real existing people. And that was already 12 years ago or 13 years ago, so a long time ago. But that was really a game changer in the industry where organizations stopped sharing microdata. They suddenly understood that, well, maybe they think they did, and they actually tried to add noise to the data and obfuscate and not share any user-level information, and still it was that easy to re-identify. So the whole industry has learned to not share data and not publicly share data. And that is, of course, a huge burden. How do you collaborate? So finally, 20 minutes in the talk, let's talk about synthetic data. That's why I'm here. That's why you invited me also. So let's start easy. Let's randomly generate a synthetic face. Let's try a synthetic face. Now, that is not really a face, right? So this is just random noise, but it has some 400 pixel height and 300 pixels width. It has colorful pixels. So if I just try for a long time, maybe a face comes along. No, this needs to be repeated very, very long time until a face emerges. So this is not working. But this is kind of the analogy to completely random dummy data or mock data. Yes, of course, you can generate structurally correct data that is within the same domain, the data domain, the value domain as the original data, but it's useless. It does not convey any information other than the structure that this is 300 pixels times 400 pixels. So what is the next step that we see out there? And that is you just ask an expert to create data. Now, I'm an expert in human faces because I've seen my whole life human faces, so I'm pretty good in this. So I've drawn for you a face, and that is the face. Good. So this is with all my expertise. Like, of course, I know a bit more about faces, but this is at the top of my skills. How it will look like if I draw a face. Now you get an idea how a face looks like. Let's assume you have never seen a face. So you're aliens from Mars and you want to know from me how a face looks like. And I'm going to show you this and you're going to, okay, well, that's interesting. So there are these 2 eyes and some nose. Okay, you learn some properties. There's some usefulness in there. But it's also, probably you want to have another face and then I say, okay, wait, I'm going to draw another one and another one. And this will be, of course, very overly simplistic and it's totally biased. It's just my own assumption of how faces look like. This is not representative. So let's get more sophisticated and let's use a model. And so I work together with a computer. I'm going to inform the computer how the basic physics of characteristics of a face, and together we can then generate more faces. Great. So this is fantastic. So this is a major step forward. This is synthetic data, model-generated synthetic data, still very much informed by my own assumptions and hypotheses about how the world looks like, and it will help me to recreate an arbitrary number of new synthetic faces in different lightings. So this is a major step forward. But what has now really changed is generative AI generating completely autonomously, so without human intervention and without humans informing the machine about properties of the human face, new faces. And then they look like this. And this is shocking. Like for images, this was already the state 6 years ago. But this is the same technology that is behind ChatGPT, behind Midjourney, behind those papers that were published 6 years ago, that is enabling with generative deep neural networks to train based on a large amount of data without any assumptions on the distributions, and help us to recreate new personas that have never existed. So this person has never existed, and we can generate 1 million more. And they're all shockingly realistic. I think this is mind-blowing. And this is what me coming from the field of structured behavioral data made it kind of obvious, like if we apply generative AI to structured data, there might be an opportunity to recreate synthetic populations that are shockingly realistic and still useful, because you can learn so much from this AI-generated synthetic face if you would not have otherwise access to the original data. So that is the assumption. You don't get to see the real people. So you see synthetic faces. You can study the properties. You can see that there is a correlation between the left eye color and the right eye color, that there is a symmetry in the face. And there's so much things to study that supposedly the shape of the chin and the degree of the whether you have a beard or not, and whether you have hair on top, and so there's millions of correlations that are implicitly there in the in an original face that were picked up and able to be reproduced by the machine. But it's really a probability model underneath. So there is a very flexible, very powerful, high-capacity deep neural network that is just fitted to the original data with the task, with the loss function, to generate new realistic samples that are as close as possible to the original data. And that same technique can now be applied to structured data. So let's switch over to structured data, and let's assume we have a data set on a population. This is kind of a toy data set. I will then have later on a bit more wider and taller data set. So you start looking at this. No, don't look at this. You don't get access to it. Sorry. This is super interesting data, but I cannot share it with you. So sorry to spoil the party. You started already thinking, oh, maybe there's age and gender and income. That would be interesting to study. No, sorry. You have to ask me because I'm the data owner. Now you have to ask me what you want to know. And that is, of course, a tedious process. Okay, please, I would like to have this type of analysis. I will send you over some slides. You will look at the slides and you will think, no, I want the data. I want the raw data. I want to be creative. I want to do a cluster analysis. I want to train machine learning. I don't want to be restricted by a SQL interface or by a human expert that sits on top of the data and is safeguarding the data. No, you want to have access to the data. So what you can do, and this is kind of our play in this field, is so there are synthetic data generators, there are open source libraries, as well as there are vendors that just allow you to upload your data and press a button and synthesize the data. So we have completely automated the process to the point where whether this is running on our cloud, on your cloud, it does not matter. You're uploading, you're as a data owner, you're provisioning the data, you're connecting to your data source that is privacy sensitive, you press a button, the existing data is analyzed, generative AI model is configured, it's trained, it's very compute intensive, so it takes a while. In this toy data set, it just takes 50 seconds, so you can try it also on our website. And then you get a quality assurance report as well as the synthetic data that tells you, okay, how good is the synthetic data, how private is the synthetic data, and here do you want more data? Because you gave me 50,000, but you can also ask for 1 million. Right? But the statistical information is, of course, only the, as good as the original data. So if you have missing data, you will get missing data. If you have crappy data, you have crappy data. So it represents the original data. That allows for this really a transparency around the data. So here you now have the structured synthetic data. It has the same structure, the same properties, the same fields. It's human readable. We can all reason around those samples, and we can use that now for machine learning training, for machine learning validation, for analytics, and whatnot, for testing APIs, for development. But the key question is then, of course, no, that is on the next slide. Before I go to the key question, but I guess you can guess the key question. So with that, synthetic data becomes a new lingua franca. It allows access to the micro level, to the micro data, and be able to collaborate across teams, across organizations, across countries, across continents, and across population groups. Because you are not abstracting away onto statistics where you are then only able to talk to statisticians, because you're suddenly introducing a language around model parameters and alphas and betas, and you kind of lose all the rest of the population. No, you can actually show everyone how actual data looks like, and in particular, you can also use that to train, but more importantly, to validate machine learning models. So if you're a researcher and you're working with microdata, you might have run into the situation that you've come up with a clever conclusion and you want to now show the world, but if your data that it was trained on is sensitive, you cannot allow others to reproduce your results if they don't have access to the same data as you have. So this is a fundamental dilemma. So AI-generated synthetic data, if it is realistic, representative, and truly anonymous, that you can be shared with data consumers, so they can learn, they can collaborate, and they can also innovate. And particularly this innovation, this exploration phase is so important, where you don't want to restrict yourself beforehand. Like a lot of time, particularly in a private setting, it goes like this: you are a clever new joiner to, let's say, a bank. You have a new crazy idea what you could do with the data, but since you have never seen the data, you cannot prove the data. And then you're asked, okay, please calculate me the ROI and tell me how much bottom line revenue you will get with this idea. And you were like, no, sorry, I was just getting creative. I thought we could improve our services by doing this or that. No, you will never get to the point. So you cannot, because the data is so sensitive, you need to have all sorts of safety and guards. You cannot just come along and have a crazy idea and just try it out. So the exploration on top of data is so important, and that is not, again, that is not just restricted to the data scientists, but that is involving all sorts of people with a different background that are able to come up with creative new ideas what to use the data for. Okay, no, again, not the key question. So this is the value proposition that I'm talking about today is primarily around privacy. And this is also the key driver for customers to engage with us. They have a privacy issue. But the generative AI, the power of generative AI, and we see it with ChatGPT, allows for much more than just privacy-preserving access. Generative AI also allows to debias data. So you can intentionally form and shape the data. There was a historic bias. You can ask specifically for that bias to be removed. There was a data that is incomplete. You can ask the generative AI to complete the data. Does that work? Well, sometimes it works really well. Like just like ChatGPT, you go there and you figure out like, wow, that is clever. And then you can go to ChatGPT and ask it about some freak event, like who founded Mostly AI, my company, and you will get very creative answers, but nothing like the truth. So your mileage may vary, but it is informed by all the historic data, and it is in a very good position to be able to interpolate, right? So not to extrapolate, but to kind of to interpolate and give you more samples. And yesterday I gave the example of, let's say there's a 90-year-old female computer science student applying for a loan. Well, what should you do? Right, so that's not kind of in your training data set, but the model will have a certain assumption, not assumption, intuition built based on all the historic data, whether the gender, the age, or the field of study is likely to influence whether the person is going to pay back the loan or not. So, 3 value propositions around privacy, fairness, and imagination. But for all of this, the key question is how accurate is that? Because if the data, the synthetic data, and I've shown the full range of synthetic data, if we just talk about user-generated data or also this more traditional model-generated synthetic data, so you get a varying degree. And also with the deep learning based, with the AI-generated synthetic data, we were able to see the progress with the synthetic faces, and synthetic faces 10 years ago were a laugh. Like you looked at it and like, come on, like, why are you even playing around with this? And then 5 years later, they're like, oh, wow, okay, no, okay, this is shocking. Like, and now we're talking. And the same is for structured synthetic data. It's just the problem in a way, it's less obvious. So you're not looking at 1 million financial transactions and say like, wow, because we are not trained to recognize all the deep patterns that are in there in the original data and able to verify whether they exist. So there are 3 simple ways to and I think I need to speed up, how to validate, how to measure. And the first one, I will quite quickly discard. This is kind of like asking a human whether you think something is fake or not. So for images this work, is this a fake or real image? And then you can judge. You can not just use humans for that, you can also train a machine to play this adversary and be able to detect between fake and real. Now you can do the same for structured data, but all that it's doing is checking for realism, that is for rule adherence. And because we are very good in spot violated rules, so if the synthetic data of a synthetic face consists 3 eyes, we kind of know that something is fishy, right? Even if all the other things are perfect, there's a 3rd eye somewhere here on the cheek that is weird, and so we say like, no, this is useless. Now, more important than the realism, because the point of synthetic data, what we are doing is not to fool humans in believing that this is real data, but it is to inform people about the statistical properties of the original. So it is all about the statistical representativeness. And that you can measure in terms of the fidelity, in terms of the statistics. So your statistical queries that you perform on the synthetic data, do the results match with what you get from the original data? And in terms of the utility that you get from training a machine learning model on synthetic data, and you do a side-by-side comparison with training the same model on the original data, and you validate it on an actual data. So this is called train synthetic test real. There is of course no point in training a synthetic machine to train a model on synthetic data and then validating on your own synthetic data. That is kind of useless. You want to know whether you have learned, whether the synthetic data has captured the signals that are in the original data, and whether you can learn that with a model, you pick it up, and it helps you to predict something in the real world. And there you have your measures, right? So there you have probably your performance metric, and then you make a side-by-side comparison. This is what typically is happening when we are being evaluated. So depending on whether this is more in the field of analytics, then the customers look at marginal distribution, specific properties, are they retained, or they look then for machine learning performance. Now, this is just me talking so far, and of course we have tons of benchmarks on our website, and I will, if time allows, still show you some of those, but I'd much rather like to point you towards this very long technical 89-page report by the Joint Research Center of the European Commission. They did a study on synthetic population for policy applications, and they used our software to synthesize 2 million cancer patients, and they did this within their own premises. So we never touched the data, we just provide a solution, they pressed a button, they got 2 million synthetic records, end-to-end synthesis. Their use case is for cross-border, enabling cross-border research. They did tons of visualizations in the report, so it's actually not all the 89 pages are on this one, but the whole chapter 6 is on this one. Many side-by-side comparison. Okay, this is the analysis, how it looks like for the real data. This is how it looks for the synthetic data. I'm not a field in this either, so just as well as I'm not a field in systemic risk analytics. But for them, this was shocking because the machine just has reproduced those patterns as well as is privacy preserving. And they do this at a very high level, as well as then they start zooming in. And of course, the more you zoom in, the more you get to your very rare cancer typology, where you just had 50 people in the original data, you get more uncertainty, you get more variance in the synthetic data. But the general patterns were all perfectly matched and retained, and you got the identical findings. And it is surprising that this JRC paper, given that it is a very technical paper, is overly enthusiastic in their conclusions. This is crazy. We could not have asked for more. They called synthetic data now the key enabler for AI in Europe. It is the perfect input for machine learning and AI models. So all of these are actual quotes from the report. I did not make them up. Synthetic data changes everything from privacy to governance. Synthetic data eliminates the bureaucratic burden. It has the best price-effort ratio for privacy-preserving techniques. So they compared with homomorphic encryption, with multi-part secure compute, and so forth. So they were quite amazed that you have to just provide the data, press a button, and you get synthetic data, and you can get going. At the cost of introducing uncertainty. So there's the variance. Now, they consider it to be the go-to method ready to be deployed. And of course, I have to point you to this one. So if you ever start going into the field of synthetic data, then please consider that commercial solutions like us still beat the available open source solution by a huge margin at the time of writing, but this has not changed, I can tell you. So there is really a fundamental difference. Don't allow just the available open source solutions to inform you about the capabilities of synthetic data. The commercial solution providers have far much advanced, because this is not about toy data sets. This is not about I'm synthesizing the Titanic data set. This is about synthesizing 2 million cancer patient records, where we have 10,000 different cancer types that we have never seen before. And it just, the patterns are captured. The results are impressive, but more important, I would like to point you here on the right-hand side. And sorry for reading this out, but policymakers will have the opportunity to create radically new policy instruments based on more detailed, less biased population data. They can embrace diversity by stopping averaging out and thus marginalizing of underrepresented minorities, by shifting away from aggregate level statistics, capture the full diversity within the population and start coping with its complexity than rather to continue ignoring it. So those are very strong statements, and you can kind of sense there's a bit of a skepticism of the author towards the established way of aggregate level statistics that are, of course, marginalizing out the minorities. Yes, by definition, you are aggregating. You cannot capture all the diversity in the original distribution. You are overly simplifying, and with that, you lose a lot of the detail that is actually available, that would be available. Data democratization, a new type of open data, would then emerge from the shift towards synthetic data. Synthetic data and policy-making process will enable involvement of much broader communities, and this is what I try to express with the emojis. So it's not just the same type of people that today have access to the data. No, you can actually collaborate with a far broader audience. And the same goes for algorithmic governance. This is the AI regulation part. This is the AI auditing, that you introduce governance, and for governance you need access to the data. I will go into that in a second. And also going further to data literacy is today what was computer literacy in the 90s, and synthetic data can really be a mean to accelerate data literacy. Okay, there's another study. It is on financial data, by the way. It's together with NVIDIA. There we synthesized 11 million housing loans, but the purpose there was to show actually the important use case on AI audits. With an increase in AI risk, there will be an emerging industry taking shape that will deal with how do you audit, how do you govern, how do you assess the risk of those AI models, how do you stress test the AI models. And for that you need data, but if the original training data is so sensitive that you cannot share it, you need some other data. So let's use AI-generated synthetic data. It's structurally identical, and there is tons of explainable AI packages out there. In this case, this was SHAP, and they were just a post hoc analysis of a model that was trained on the original data. So let's assume there's a model that was trained on the original data that is shared with an external, and that external is now supposed to study the behavior of that model. Well, for that you need samples. So you need something to probe the model. That is the only way. It does not help if you study the model parameters or you study the program code. No, you need to study a model by actually probing it with data. But you need realistic representative data at scale. It does not help just have dummy data to probe an AI model. You need realistic representative data. In order to figure out, is there a discriminatory bias within the model? Is the model performing well for everyone? Or are we penalizing minorities? How does the model behave for weird edge cases? What happens in the case of a 90-year-old female computer scientist applying for a loan? Like, the only way to find out is to probe the model, and for that you need not just those 3 attributes, but you need the complete history, and you need to make some assumption. How much money does she have on her bank account? Does she have other loans? And all the other 1,000 attributes. So you cannot just make that up. You need a generative AI that helps you to actually help with that. So, and what this study does, it shows that you can gain identical insights on the AI models by using synthetic data. But what is also interesting is, if you now have a data area that is rather sparse, so underrepresented, you can generate more data in that specific area to study in more detail how the model behaves. So this is about learning about the model that was trained on the original data, how that behaves in certain sparsely populated areas of your data space. Yeah, and last but not least, the ability to reason around individual samples. That is kind of my key driver, actually, where I want to see a world where we are all having a public discourse of how models should actually behave, and for that you need to actually probe models and then study and see how they behave and how they behave if I change something. So if I go to the bank and I get a loan, well, because I'm 45 years and male and white, so great. What if I would be wearing glasses? Okay, I still get the loan. What if I had a different ethnicity? Oh, the model suddenly tells me I don't get the loan. Wait, like, what just happened? I don't need to be a mathematician to be able to start a debate. I can debate with my kids as well as maybe with my parents around the ethical aspects of the models that we deploy. But for that, we need broad common access to representative data that allows to probe those models. So you can inspect AI model behavior with individual synthetic samples. And that's a quote from NVIDIA. Of course, they're very much into this because, well, they are selling the chips that power the generative AI, so they are, of course, a bit biased, but I think you can trust them. One of our lighthouse customers is also Swift. So for them, there's not too much details and charts that I can share, but I can share that they are our customers. So they are synthesizing millions of financial transactions that they are processing. They do this on our platform. Primary use case is internal data sharing, but with very much the idea to opening up those data assets to also other collaborators to develop AI models. No, I will not go to the details. What I was what I'm not going to tell you, but that will be distributed as part of the slides, and there's anyway a long blog post on this one. It's a study on population data at scale. So this is about 1.2 million actual records with 32 attributes, and how you can actually validate and reproduce those results. So there we split into a training and a holdout data set. We train a machine learning model. We show all the, so we make all the things that I've just said kind of reproducible for anyone out there together with our platform to really stress test and validate any of the claims that I'm making here. But I will rather like to conclude and then opening up for questions that I think there's no doubt that data can be the foundation. Data needs to be the foundation for an open, resilient global economy. But we need to start shifting to a micro data level, from an aggregate level to an individual level. And that needs to be enabled by synthetic data. So data needs to be available for research, for education, for analytics, for innovation, for policymaking, for the public discourse, for developing AI models, for stress testing AI models, and for regulating AI models. And with that, I would like to conclude and on a positive note and see the big data opportunity, and that is synthetic finance data as a new lingua franca to also unite for systemic risk analytics. And I never close a talk without sending you also to our free service, and whatever I just told you can also try it yourself and get a go with it with you yourself, you online or your colleagues in your team to actually embark on this synthetic data journey. Of course, despite all the promises and all the opportunities, there are pitfalls, there are limitations, and there is a transformation process in order to get there. Thanks a lot.
Thank you. Now it's time for questions.
Thank you. Super, super interesting. I have a question on the audit of AI that you talked about and the stress test, because I love the idea of generative AI, but I'm also scared about the fabrication or the hallucination. And when you see research papers that whose titles have been totally fabricated, it's quite shocking, and they look totally real or realistic. So can you talk a bit more about that, AI, audit, and governance? Because you're saying don't go to the open source, they're not going to be good. How do you ensure that you're not fabricating some statistical properties?
Yes. So it is the key question. How accurate is it? How faithful is it? How much can you trust the synthetic data? And there is no binary answer to that one. And I will duck the question and kind of point towards other data sources that we have learned as a community to adapt and accept that there is uncertainty attached to it. But that is a learning process that only happens through action and by actually dealing. So how do you figure out that ChatGPT is trustworthy? Well, you ask it a couple of questions, and a couple of times you probe that ChatGPT, and you build up trust, and then you find out well, there are some certain domains that will give you accurate answers, some certain domains that don't give you answers, and then there is maybe some domains when you ask it 10 times in a row, then you get different answers. So you will be able to learn. And similarly for self-driving cars, of course there is regulation in place, there will be safety standards in place, but for you as a customer to trust a self-driving car, it happens by at some point embarking on a car and watching it drive and then starting building up that safety level. Now we all go on an airplane, we trust that the autopilot is not going crazy, so no one thinks about it anymore. We all started to trust the algorithms. So the same is kind of the argument that I'm making here is there's no binary answer. It might be better, a lot better than what you currently think the synthetic data is already capable of and the generative AI is capable of. But the only way to actually figure it out, how good it is to stress test it and get going and get started with it. The hallucination problem, or allow me also to counter it with the other alternative. Like, what is the other alternative? Not being able to share data, not being able to reproduce results, having a scientific community that grows and gets more and more dependent on microdata, but not being able to reproduce. We have seen fabricated data without synthetic data also in the past. So it is a tool, and it requires using the tool in order to understand its limitations and its benefits.
Yeah, thank you for the presentation. I think this is very interesting. Just one thing that I was wondering. So if you use this synthetic data, and then you want to do a model or something, and you want to evaluate or do accuracy, then you want to do something out of sample. But if all the data are based on one data source, can't you introduce some kind of bias into that accuracy? Or
sorry, so whether there's a bias introduced within the...
Yeah, because when you make up all your data on synthetic data,
right?
Then if you want to do a traditional machine learning model, you take out something for training and then you do something for testing. But the data you have for both training and testing comes from the same data set.
Same distribution, typically.
Yeah, same distribution. Then don't you introduce some kind of bias in the test data set relative to the training?
No, so are you not talking about so the evaluation? If you train a machine learning model on synthetic data, you in order to reassure you that it's really performing as good as the original data, the synthetic data, you evaluate it on actual data.
Okay.
So if that was your question, yes, you don't evaluate on the synthetic data. That is key. Yeah.
There's one question from the chat from Tamirat. She is asking, what is needed to generate medical data? Do we need to sample real data? And what if we don't have it?
Then I cannot help, unfortunately. I'm sorry. If you don't have data, I'm not gonna fabricate data. There are, of course, mock data companies out there. There are also more sophisticated kind of this model generated data. This is has certainly its purpose and its fit, where you as an expert, you introduce certain assumptions, you fit the model to the real data, and then you simulate more data. We're primarily focused around the deep neural networks applied to structured data and showing how to completely automate the process and decouple it from the assumptions so that you allow a learning process to take place where we all learn from the synthetic data without first starting out by the assumption. Just like the synthetic faces were never informed that a human has two eyes, they just learned it. And the same thing happens for structured data.
Hi, thank you, Michael. This was really interesting, and I love what you guys do. And this seems for me the way to go as well. I think this is a more slightly a philosophical question. If you can provide sort of a short answer, that would be appreciated. So you said that you're creating with your tools, you're creating representative and realistic yet anonymous data. What popped into my head is, let's say we have a very unevenly distributed data. You have a large counterparty, for example, in the financial data that dominates the sample. Yeah. So if you create a representative and realistic sample with such a one dominant participant in the data, how do you preserve the anonymity in that case? And so where does the definition of synthetic and real, when does it trespass from one to another? Thank you.
No, perfect. And I kind of skipped on the whole question of privacy evaluation. So how do you figure out that the synthetic data is truly anonymous? And the way that the lawyers also approach it when they stress test the synthetic data generators is they provide a population and then they always leave one out. And we need to show that the synthetic data is robust against the removal of any individual entity. So in your case, we're actually not able to be statistical representative for distributions that are dominated by a few major entities. So, and we've had this discussion. We had also the earlier the earlier we actually talk about limitations of synthetic data, the better it is, because there is no way to hide the Finnish postal service in your statistical database of enterprises in Finland. You can certainly hide the small and medium enterprises because one hairdresser is kind of like the other hairdresser, and there's some restaurants as well. But the postal service you will not hide away. So the technique works very well for a large number of smaller units whose privacy needs to be protected, particularly for customers, for users, for individual persons. But when you move to an organization level, you need to also have a large number of organizations. You cannot synthesize based on 5 entities a new population. You really need 1,000, 10,000, 100,000 of samples for this to work well.
Yeah, thanks. Yeah, this is, as everybody said, this is really fascinating, and you've showed us a lot about the end, about the beginning and the end, but there's like this black box in the middle, and you're talking to an audience that understands a lot about probability distributions, about Monte Carlo experiments, about sampling, and about estimation and optimization and all that kind of stuff. Could you give us at least some sense of how it is you're using the real data to generate even one synthetic data point? Because you didn't say anything about how you do this.
Exactly.
And I guess in order to feel comfortable with it, I would want to understand what the process is that you're actually using. Otherwise, I wouldn't want to use the data.
Okay, that's interesting. Do you know how ChatGPT works?
I have no idea. That's what you're going to tell me.
Exactly. So there is, of course, some secret sauce in order to apply generative AI to structured data, and that is where in the unstructured domain you have the benefit of a rather smooth data structure. You have pixels or you have word tokens, but they're all the same. With structured data, you deal with, there's a binary column, there's a date column, and so you need to do some encoding, but then the principles are basically the same as for any generative AI, and there are 3 dominant streams in the generative AI, and you can kind of pick your favorite. The one are the GANs, those are these generative adversarial networks where you have a model, 2 competing models. The one is just generating random samples, and the adversary is telling whether this is fake or not. The adversary gets better in discriminating, and with that challenges the generator in getting more and more realistic. And so this is a game theoretically, a setup where you have 2 competing machine learning models getting better, and at the end you have a highly realistic data generator, and that is behind a lot of the synthetic images that you see out there, the dominant model class. The other class are kind of variational autoencoders, and the third class are, which is kind of like, you can think of a compression layer where you try to predict the output based on the same input, but you force it to go through some compression. And then you can use that sample, the latent space, to sample from that and decode it, and you get as well new synthetic data. And the third class is kind of what's dominant in the large language models, that is an autoregressive network where you always feed in a sequence of tokens, and you have a probability distribution for the next token. And theoretically, it can be any of the 50,000 tokens of your vocabulary, but you have a loss function that teaches you the next word is hello, right? And then okay, what is the probability of the next word? And then you start sampling, and you have that autoregressively go through that, yeah? And it's a combination of the first and the third, kind of to make it work for structured data, but that's about as deep as. That's the 5-minute version.
Thank you. I think we could continue with the questions, and I will have a last short question here, but the time is up. But I will continue with this. If you would expose your algorithm, then it wouldn't be anonymized anymore.
That's not true, no. So my algorithm is not anonymous. Yeah, of course.
Yeah.
So I need to mask it.
Yes, you have to mask it, because if everybody know what kind of algorithm mostly AI uses and know the data, who has the data source, can they not backward in this? Let's take. Not in this statement. Let me finish the question. Okay. So let me assume that you have a lot of interesting customers. Okay. And then there's a group of highly educated and highly financed people that are very interested in your clients, and they come posing as your client and gives different kind of data that they want you to anonymize for them. And with this kind of data they get from how you have been anonymizing their different kind of data, could they somehow get some hints how you will how you do that and get some kind of privacy issues in the end? I'm thinking now a few years ahead.
Yeah. No, thanks for the question. I think it took me a while to understand the background. So we never touch data. We provide an algorithm to organizations that then independently synthesize the data. So we are never exposed, and there's no information flowing back from a trained generative AI towards us as well as to any other entity. The output of this process is always the synthetic data itself and not the model, and the model is not even persisted if you don't want to persist the model. The other aspect is, no, just there's no reverse engineering of the code. So the issue is not whether it's a business decision on whether we have the logic open source or proprietary. There are plenty of open source solutions out there that can also be tried. The privacy test is happening always empirically on top of the synthetic data in comparison to a holdout data. So you are checking whether the synthetic data behaves with respect to the training data just as actual holdout data that you have never seen before. And if you're able to establish this algorithm, you can be guaranteed that there is no privacy leak because there's just as much information contained in the synthetic data as in the holdout data, but you cannot claim a privacy violation by someone else being in existence. And that is the argument.
No, that was a good answer. That's why I wanted to have clear. Good. Thank you very much.
Thank you.
So, excuse us for taking a few more minutes than we should, but let's continue with the next session now. We have banks and non-banks stressed, climate risk and the mitigation role of insurance companies. Is Gabor here?
Okay, thank you very much to the organizers for the opportunity to present this work. This is a joint paper with a number of colleagues listed below. Some of them are working at the European Central Bank, some of them are working at EIOPA, and some of them are working in academia. This work is our second step on a long journey in developing a system-wide stress test model, specifically for the euro area. And I have two disclaimers here. The first one is that in the title, climate risk is just a scenario, so we don't focus on climate risk. We focus on developing a system-wide stress test model, and we demonstrate the abilities using a climate risk scenario, but also later on with any kind of scenario. The second disclaimer is the usual. These are only our own views. First, I will give a general overview. Since the time is limited, I will not have time to go into all of the details, but I'll start with a general overview, then some more details about the model extensions, and then some results. So our goal, as we also heard yesterday during the first keynote speech, we want to extend the number of financial sectors covered in a stress test model. This area has been rising in the recent years. It's quite a new area. In the first examples, I showed some of the multi-sector stress test models developed. For example, the first one, Aikman et al., is a representative agent model, including several financial sectors. But the caveat here is that there are only representative agents. On the other hand, it's an equilibrium type of model. The second example is by the group of Doyne Farmer, who was a keynote speaker last year. They develop a granular stress test model with several financial sectors, but they don't have access to confidential data, and their modeling of the insurance sector is also a bit limited compared to this work. The third example is by Roncoroni et al., who develop a model for banks and investment funds, and they also use it for the analysis of climate risk. And the final example is a working paper of our team at the European Central Bank, where we developed a model for banks and investment funds. And this step is an extension of this model highlighted to include the insurance sector. Regarding insurance stress tests, the literature is also quite limited in this area. The examples listed here all belong to the same group of academics, and the novelty in their approach is that they try to mimic the behavior of insurance companies by taking into account the liability structure of insurers. However, for example, they don't model unit-linked insurance contracts, and this is only calibrated for Germany, most of these papers. What is our contribution is that we extend our previous two sectors, systemized stress test model, to a three sector one, including a detailed insurance sector. And to our knowledge, this is the first one which is covering also insurance companies and building on granular exposures. And I will show some of the features which are, to our knowledge, the first one to account for. In this slide, I show the risks covered in the model for all the three sectors in the financial system, for banks, funds, and insurance companies. I will briefly go through these. First of all, we cover direct contagion via credit risk and defaults. It means that if an entity defaults in the financial system, then we look at the liabilities of this entity, and these are losses on the asset side of other financial entities. Furthermore, if an entity defaults, the securities issued are also affected. These prices go to zero, and this has also an impact on the asset side of other financial entities. This mechanism is implemented for all three sectors in the financial system. The second risk is the so-called solvency liquidity feedback loop, where for banks we assume that if the bank is in solvency distress, then it leads to a short-term funding shock. So the solvency shock is converted to a liquidity shock as well. The third risk is direct contagion via market risk. We look at all the bond, equity, and fund holdings of all the three sectors included, and we update the prices after the materialization of the shock. The following shock is indirect contagion via market risk. It means that when we look at the securities holdings and fund holdings, we also take into account the overlapping portfolios, and we use security level price impact parameters for fire sales. This work was presented last year at this conference. And related to the previous channel, all sectors face liquidity shortfalls in the model. These are the triggers for forced fire sales. So for banks, we have the funding withdrawals. For funds, we have the fund redemptions. For insurers, we have the so-called surrenders. Furthermore, one more insurer-related risk is the changes on the liability side. Insurers are quite special entities, and they are constantly updating the liabilities by calculating the so-called technical provisions. These are the best estimates of the liabilities. So the liabilities of the insurers are the future payments to the policyholders. And when they are discounting these liabilities, they take into account the yield curves. If there is a change in the interest rates, this affects also the discounting of the liabilities. And with this, we also model the duration gap of insurance companies. Below in the box, we saw some recent examples. We also heard about some of these yesterday. And we think that these risks these risks are able to capture the vulnerabilities in the financial system if you model them properly. The next slide is an overview about the model itself. I will try to very quickly go through. So on the left side, we see first round effects. On the right side, we see second round effects. The first round effects, we also call them as exogenous impacts. On the right side, the second round is we also call them as endogenous reactions. So we have a stress test scenario. This can be either a deterministic or a stochastic market shock. We can have top-down credit risk parameters, but also stochastic defaults of companies which are on the asset side of all financial sectors. These are the solvency shocks, but we also have liquidity shocks. For example, for insurance companies, we have the surrenders. And once we introduce the stress test scenario, we assume that there is an immediate impact on the asset side of the sectors. We run a price equilibrium algorithm. We calculate the fund redemptions using a flow performance relationship. We model the insurer's loss absorbing capacity, which is the most important new feature of this model. And we also adjust the liability side of the insurers, which I spoke about earlier. In the second round effects, these are mainly the liquidity-driven mechanisms. Whenever there is a new default, we run again a price equilibrium algorithm. We assume that banks are able to withdraw funding from other banks. We also assume that solvent but illiquid banks have access to interbank funding via unsecured borrowing. And if there are further liquidity shortfalls for any of the entities, they can decide to redeem fund shares and sell securities in a pro rata manner. And also in the second round effects, we model the insurer's loss absorbing capacity. And this is iterated until there are no further losses in the system. What is the data we cover? So for all the three sectors, we have granular information on the holdings. For banks, we use CoRep, FinRep, securities holding statistics at banking group level. With this, we cover granular exposures, but we also cover the missing granular exposures by taking the residuals from the aggregate statistics from CoRep, FinRep. For investment funds, we use LIPR IM data, which is also granular security level information about the holdings of investment funds. For insurance companies, we use also the securities holding statistics, but this database is at country level. So for insurance companies, we are only able to model them at country level. And we also have publicly available, but also confidential data from EIOPA, from the Solvency II templates. And I think the rest is not so important. To close the system, we have other financial sectors. Using all this data, this is a representation of what we have. On the left side, we see the sectors. On the right side, we see the share of total assets. So, for example, the most important takeaway from this slide is that if you look at insurers, on this pink line, for example, fund shares are 36% of insurers' total assets. So from this we see that funds and insurers are highly interconnected. Another interesting fact is that funds holdings, if you look at investment funds, securities issued by NFCs are approximately 67% of total assets of investment funds, while banks are more diversified. This is another representation of the data we have. On the left side, we see the loan exposures. Importantly, we only have loans from banks, so this is the only source of loans, banks. That's why they are in the middle of the chart. On the right side, we see the securities holdings networks. Here there are much more interconnections because all financial sectors can hold securities issued by an entity in another sector. And here we see that we have only 18 aggregated insurers. I will continue with some more details about the model extension. First of all, we improved the liquidity shock modeling for investment funds. The liquidity shock for investment funds are obviously the fund redemptions. We assume that the initial exogenous fund redemptions are coming from outside the financial system, so we calculate the holdings held by external investors. This is written in the first formula. So we sum up all the bond, equity, and fund holdings and cash holdings. We subtract the loans of the funds and the fund shares issues. This gives the external investors holdings, and we shock this amount with this row I, which is calculated using this so-called flow performance relationship. In this step, we follow the papers listed in the slide. So once we have a market shock, we can update the prices of all investment funds, and using the performance of each investment fund, we can calculate the modeled fund redemption. Since flow performance coefficients vary depending on the type of the fund, we also have to calculate the share of government and corporate bonds and equities in each fund. For this, we use the so-called look-through approach, which I will talk about a bit later. The source of liquidity shock for insurers are the so-called surrender shocks. It means that if there is an insurance policyholder, he or she is able to cancel its insurance contract, and then the insurer have to pay out an amount which can come from a unit-linked insurance or an endowment or savings contract. And we calculate the so-called surrender value from the technical provisions exposed to Mace Labs. This is also based on EIOPA statistics. Here we assume a constant surrender shock, which is 5%, and it's not scenario dependent at the moment. And once insurers face this redemption or surrender, they can redeem fund shares and liquidate their securities. The most important novelty in this model is the so-called loss absorbing capacity, which we think that this is the first paper taking this into account for insurance companies. The main idea here is that insurance liabilities are able to absorb market losses, because if there is a loss on the asset side of the insurance company, it can transfer these losses to the policyholders. In the life business, it is via a reduction in the discretionary profit participation. For unit-linked, they can potentially transfer the entire losses to the policyholders. How do we model it? We use Solvency II reporting. No, I think I will not have detailed, I don't have time to go into all the details, but the idea is that the solvency capital requirement of the insurer is calculated as a value at risk measure, which is a difference in the changes of assets and liabilities. And if we rearrange this equation, we get that the change in liabilities is equal to the change in assets minus the solvency capital requirement. And we assume a non-linearity in this setup. So delta A S2 is the impact of the shock assumed in the Solvency II reporting. And once we are above this shock, we assume that the amount of losses transferable to policyholders are limited or constant above this value. With this, we are able to calculate the changes in liabilities for insurance companies, and we estimate this ability at company level for solo insurers. This estimation was done by colleagues at EIOPA. We can have a look at the regression results. We used the significant coefficients for 7 countries. For the rest, we only used the EU-wide regression results. And also an important part is that this loss absorbing capacity is only reported for equity and bond holdings for insurance companies. Therefore, we have to derive the capacity for fund holdings, and this is done by a weighting of bond and equity coefficients, also using the look-through approach. What is the look-through approach? In this step, we can write down the total assets of each investment fund in this matrix array representation. We can calculate the share of, in this example, the share of bonds in each investment fund in the second equation, and after rearranging and taking the inverse of the matrix here, we can calculate the share of bonds in each investment fund. The same can be done for the share of equities. We can also show that this matrix there is invertible. So we have the share of bonds and equities in each fund, and we can use these shares also to calculate the LAC at insurer level. The usage of duration of liabilities is much easier. We just use the effective durations at insurance company level and the change in the interest rate, and then we get the new value of liabilities, which have an impact on the solvency of the insurance company. I will quickly go through the results. So first we look at a hot house world scenario prepared by NGFS. We use inputs from our colleagues, but also from ESMA and EIOPA. This slide shows how the loss absorbing capacity works. So on the right side, we see the value of the loss absorbing capacity. On the left side, we see the final adjusted insurer losses. And what we see is that this loss absorbing capacity is eventually very high for the insurers. So it's very important to take this into account when we model the insurance sector. On this slide, we show aggregate results from the hot household scenario. The main takeaway is that first round effects are quite limited and mainly driven by credit losses of banks, and in the second round losses, obviously fire sale losses are the highest, but here we assume the 5% surrender shock for insurers. So the second round losses are mainly driven by this assumption. And importantly, the reaction of insurers and funds are highly intertwined because insurers hold fund shares and funds face redemptions, and they all engage in fire sales. The next slide is just a demonstration about the capabilities of the model. So we have very granular information at bank level, at fund level, and at insurer level about all the different kinds of losses. In the first row we show first round losses, in the second row we show second round losses, and it's also visible here that insurers have the lowest amount of losses among all the financial sectors. And that's why we say that insurers have a mitigating role. In the following slide, we look at the impact of this LAC modeling. So we run two simulations. In the first one, the deactivate LAC. In the second one, the activate LAC. And we run this simulation for a range of scenarios. The surrender shock goes from 0 to 10%. And we assume that there is a market shock multiplier as well. What we see here is that first round losses are only affecting insurers, but the mitigating role materializes in the second round when the LAC is able to prevent from the default of an insurer. So there is this threshold, as visible there, around 7, 8, above which insurance companies are able to default, and in that case, they generate losses to the whole financial system. And we also see that the larger the surrender shock on the right side, the smaller the difference in the default events. That's why there is this decreasing shape. I quickly conclude. So we found that insurers can stabilize the financial system. We also see that surrenders are a main source of risk, especially in a tightening cycle, since policyholders can get higher investment yields from other investments. Insurers and funds are highly interconnected via direct holdings, and there are possible extensions as well, which we are currently working on. We are trying to improve the modeling of liquidity, and we also work on the inclusion of a central bank. And that's it. Thanks for your attention.
Thank you very much. I think we have time for one question. I'm sorry for... Oh, yes.
Oh, because I have a strong voice. Oh, I see. Good. Online. Okay. Do you do any reverse stress testing? That is, to assess whether your initial assumptions make sense?
Not at the moment, but we work on this topic separately. But I think there is space to improve this model as well with this technique.
But one more question.
Until now, we haven't done this exercise.
One interpretation of climate stress tests is the whole idea is to get the institutions to stop taking these risks because the risks are faced out into the future. So the question is, how much are you assuming that they Hello? Oh, okay, there we go. So one of the purposes of the stress tests, climate stress tests, is to get the institutions to adjust their portfolios because otherwise they're just doing stupid things. So the question is, how are they adjusting their portfolios in light of the risks that they face? For instance, could you model that they have some value at risk target that they then don't exceed as the climate risk materializes?
So you're right. That's why I highlighted in the beginning that for us this is just a scenario. We didn't really focus on climate risk. We just run a scenario using inputs from other colleagues. But certainly, probably we could be able to assume something. But since this scenario is assumed to take place in 2050, I think it's quite difficult to model the behavior in 30 years' time. But probably something could be assumed. Yeah, it's 2050 here. So we just take the balance sheets as fixed in this exercise.
Thank you very much.
Thank you.
Let's continue with the next talk in this session, and that's detecting the hidden bomb, building an integrated surveillance framework for highly leveraged NBFIs. Silvia Pezzini.
Silvia.
Excuse me. Sorry for that.
Don't worry, not at all. Thank you very, very much for inviting me to present at this conference. In the interest of time, I'll be rushing a bit through. I'm Silvia Pezzini from the Hong Kong Monetary Authority, and this is joint work with Liang Yu, who is sitting among us, and who will help me take questions, and also with Zijun Liu from also the HKMA, and Kevin Chang, who was at the HKMA with us, and now he's moved to AMRO, which is the ASEAN +3 Macroeconomic Research Office, and it's in Singapore. So, usual disclaimer apply, and now after I've done the housekeeping, I can move through. So I'll take you through three main things. The first one, and it's the bigger one, it's our experience at the HKMA in building an NBFI surveillance framework. And second, we will move on to what are the key takeaways, what are the limitations of the framework, and what are our concluding thoughts on this. Oops. So this all started with LTCM, and then it moved on to Archegos. Basically, we became aware with LTCM that there were these hidden bombs through the system that we wouldn't spot at the beginning, but then suddenly we would realize they were there, and they could create large losses to the system. And when Archegos happened, it created a big soul searching among the central banks. So I think anybody who was on these FSB groups can see how many times Archegos came up in the last couple of years. And for us, including for us, it created some soul searching, like we are intensive users of TR data. Could we spot it if it happened in our jurisdiction? So we got to work immediately after Archegos, and we started to think, okay, how could we have spotted it? So number one, Archegos was not active in Hong Kong, so we had about 1/100th of the exposures that were later revealed. So we could not have spotted it, that's number one. But possibly there could be one similar entity in our jurisdiction. How can we spot it given the data we have at our disposal? And so sorry, I keep using the other one. So we immediately started to work on developing a systematic surveillance framework that would be very practical, that we would use to start to identify which entities we should start to look at. And the aim was to be very operational and practical. So we didn't start from a very fancy modeling approach, but we started to think about what do we know about these entities. And for us, the availability of granular data has been a very big game changer. So we have really mined trade repository data in all possible sorts of ways, and we have extracted very useful insights. So much so that we started to collect trade repository data in 2013. We have very good data from 2018 onwards. And then we also started a similar project on the banking side to collect granular data from banks, from loans, interbank, so commercial loans, mortgage loans, and interbank loans, on that securities held, and we continue expanding. So once we look into all these granular data sets, we started to identify more than 1,000 potentially leveraged MBFIs. So the way we defined this, the universe that we were interested in, we were not interested in the regulated entities where we have the data. We were interested in the entities where we don't know much about. And we also started to say, okay, insurers, pension funds, maybe we don't know enough, but still what we see in the data we have is not going to be their main financial activity. Whereas for hedge funds, we often find that they often take positions via derivatives, so they don't have to take the actual, say, cash position in equities and so on. So mentally we said, okay, we want to know more about the hedge funds and the family offices. Archegos was a family office. So that's our sample. We identify more than 1,000. How can we get out of trying to find, to define a risk assessment framework for them? We're not going to know each of these 1,000 entities. So we do a lot of basically the second last paragraph from the bottom, which is we reconstruct MBFI positions by slicing and dicing the granular data. So we have everything reported to us by regulated entities. We kind of pivot the data, if you like, figuratively, and we put it on the MBFIs. We reconstruct the MBFI's position. And we have done a separate regulatory exercise to cross-check. So we asked the banks, how much is your exposure to this? And we basically, they were matching very well. So we have gathered a good degree of confidence in the ability to reconstruct the MBFI positions in this way. And this is really the information that we use to identify the top MBFIs that we then keep a close monitoring on. So the main features of this surveillance framework is really to say, okay, we know something. We don't know everything. We have huge data gaps, but we actually know something from the press, from this kind of data set, from this other data set. So the idea is to pull it all together in a systematic way so we can sift through the information. And we're not going to gather the precise exposures of that specific MBFI, so it will be a bit blurry at the edges, and we will find basically not everything will be down to the unit of dollars of exposures. But the aim is to get it broadly right so that then we can move on to the second phase, which is going to be more intensive, trying to understand, even talking to them directly or trying to talk to their counterparties. So what we, here in this envelope, we have put all the sources of information that we use. So we use the regulatory data that we gather from the banks and from the licensed corporations. So we use the TR data. At the time when we started, we had 1.8 million equity derivatives trade. In total, we have about 4 million trades outstanding. We combine it with data on corporate loans because often these hedge funds are the counterparties of corporate loans of the banks. We combine it with the regulatory returns on service where you have concentration and large exposures being reported. We also look, using the TR data, we look at the portfolios of the MBFIs, so then we look at market data on stocks or other mainly on stocks, and we try to reconstruct how risky is their portfolio. On certain things like leverage, we have huge data gaps. Basically, nobody tells us their leverage, it's not public, so this is where we are. We use two proxies, being very aware they're going to be limited, but it's better than nothing. And finally, we combine with analysis of market news. So MPL, we use a bit of textual analysis to get a degree of tone and volume weighted on each MBFI, so that when something comes up, if it's reported very often or if it's very negative, this will pop up to us. So it will enter the mix. And it's actually very useful, a very useful ingredient. What is the output? The output, as I said, it's a watch list. So it's not a very precise risk assessment in which we're going to say this MBFI has this amount of exposure and the riskiness, the S risk is this or that, but it's very simple. It's very easily communicable to our senior management to say, ultimately, after taking in these data sources, after putting them through our framework, which defines impact and vulnerability of each MBFIs, after aggregating and standardizing, this is the list of MBFIs that we want to keep a close eye on. And there's going to be another more than 1,000 that we are not actively looking at. But there's a sufficient movement in and out. So we finalized the framework in 2021 Q3. So we can actually, we have now a number of data points, and we can see actually a surprising movement in and out of this watch list. So we learn more and more about these MBFIs as time goes on. And one more thing I want to say is about the risk indicators. So we started to define them. So we thought really hard about what was important to know about an MBFIs. Initially, you would think, okay, probability and impact, but there's no chance we can model the probability of default of a hedge funds, given the information we have. So we actually moved into a framework of impact and vulnerability, where the impact is really the exposure of the MBFI, or at least the exposure we know about. So the exposures via OTC derivatives, the exposure via loans, and anything else we can gather from the regulatory returns from the banks. And that's going to be kind of the size. If the MBFI defaults, how big are the exposures? So how is the direct impact? How large is that? Then we created this measure of vulnerability in which we said, okay, what is it that matters that would make them more vulnerable? So number one is the characteristics of their portfolio, whether they have a very illiquid portfolio, whether they have a very concentrated portfolio, and I'll go in a bit more detail in the next slide. The second dimension that would make them particularly vulnerable and prone to create contagion was interconnectedness. Are they interconnected to many other counterparties and some other dimensions of interconnectedness? The third was leverage. The fourth one was the market news and the microenvironment. So all of those elements would enter the vulnerability, basically leading us to say that if they have a very vulnerable portfolio, which they have to say do a fire sale of, that could create an impact on asset prices, that could create an impact on market volatility, and then you would have all the amplifiers kicking in from their interconnectedness, from their leverage, and so on. So the framework is basically structured around these two pillars of impact and vulnerability. Impact is size, but vulnerability is not about size. It's all about percentages. So how much of your portfolio is in illiquid small cap stocks and so on. So this is the output. So this is what we present to our senior management every quarter, and if needed, more often. And it has top 10 MBFIs, what is their impact score, what is their vulnerability score in an average, and also what is their score on the various subcomponents, on portfolio characteristics and interconnectedness and so on, and what is our overall assessment. So you can see it's very simple, very explainable, and very practical. How do we get there? We take all the asset classes we have in the TR data. We have equities, credit, commodities, interest rate, and FX. We take the gross derivatives positions are weighted by riskiness, and I'll say in a couple of slides more how we do that. The risk indicators are all standardized and aggregated, so they fit the same scale, so they can be used basically to produce an overall score. And the calibration of thresholds is not magic, it's not AI, it's eyeballing, it's distribution, it can always be improved. So there will be a lot at the end will be about, this has been done basically by hand based on the distribution of the data. It can always be improved based on what we learn over time. And this is the list of indicators we use. So you will see at the top it's impact, so the size. I explained about that. We take the gross derivatives positions and the bank borrowings. For volatility, we take the percentage of portfolio in volatile underlyings. And I will explain a bit more about these first two indicators about how we do it. The other indicators under portfolio characteristics are very much concentrated on the stock portfolios. So we look at whether the portfolio is concentrated in the top 5 stocks, whether there's a high percentage of, so it's also concentrated in sector, And then number 5 is the small cap stocks, because we realized, for example, with Archegos, it had a very large exposures in few stocks, but they were large exposures compared to the market cap of those stocks. So when Archegos had to liquidate those or unwind their positions, there was a large repercussions on the price of those stocks. And in Hong Kong, basically, you have to report everything that is about above every position that is above 5% of market cap. So we set it at the same threshold. And actually, this is why hedge funds use total return swaps, because they don't have to declare specifically those small cap limits. Sorry, I'm confused. I just explained the substantial interest stocks. So small cap stocks is really about just small cap, but whereas what I explained, over 5% is the substantial interest stocks. And we also look at the indicator of portfolio in illiquid stocks. Then we come on to the amplifier of interconnectedness, where we take very simply the number of counterparty, aggregate across all the 5 asset classes, as well as the bank borrowing. And there we see interesting things, because it's quite interesting to look at, from the perspective on an NBFI, where are the connections in the financial system, because bank counterparties are typically very different from OTC derivatives counterparties. So that was quite a big value added in looking at the data in this perspective. We also created this indicator, number 9, of prime broker concentration. And again, this was stemming from thinking again about the experience of Archegos, in which some of our Archegos exposures were quite big for the prime broker itself. So there were many prime brokers involved, but also the exposures were big for the prime broker. So we compute the position as a percentage of the prime broker total position. So how much the hedge fund can be systemic for the prime broker. We compute a third dimension of interconnectedness, which is via common exposures. So we look at whether NBFIs are crowding into the same trades. So we compute the percentage, again, of positions in crowded trades. For leverage, we take 2 indicators. None of them is perfect. So we would love to have leverage. We can't get hold of it in any way. So we basically aggregate all the positions we have, and we divide it by either the net asset value or the AUM of the fund. It's not perfect in any way, but it gives us an indication of the size of the positions versus the funds available. And then we complement it by an indicator of fast-growing positions. So what was the portfolio growth in the last 3 months? So if you look at Archegos, it tripled in the space of a few quarters. So we would have quoted, for example. So for example, Archegos was interesting because they had very tiny exposures in Hong Kong, but within the Hong Kong data, we would have seen a very large jump in the 3-month growth. So by that indicator, we would have seen something. And then finally, market news, I talked about that. It's a standardized sentiment score based on news articles. And the macro environment, we use it more as a multiplier, where the idea of the multiplier is, actually, I will talk about it later, so I will explain, so I won't use it now. But the multiplier, because basically higher volatility will make an NBFI more vulnerable. Either its portfolio could be more risky, or it could be more exposed to market forces. Initially, this framework had started as an equity framework. So we were really mining intensively the equity derivatives data. And then we actually started to see that some MBFIs were actually not investing so much in equity, but were investing quite a lot in interest rate or FX derivatives. So that's where we started to think about, okay, how do we bring in all the richness of the information we have from other asset classes? And so for size, for example, we take in any data we have, but we weigh by a weight on riskiness. And here we take the BIS-IOSCO standardized approach for initial margins of derivatives, which gives us an indication of the relative riskiness of different asset classes, such that equity and commodities are weighted at 100%. So whatever your exposure is, that's what enters the framework. Whereas if you take the lowest is FX. So if you have an exposure of 100, we'll only count it as 20 in equivalent terms to an equity exposure. And we also add to size, we also add the bank borrowing with a weight of 1. For portfolio volatility, we compute the volatility of the equity underlying, or for the FX, similarly, we use the volatility of the FX pairs. For interest rate, we do something else. So here, in this table on the bottom right, we give an indication for interest rate. We consider that as more volatile the long duration contract, because you don't know what's going to happen beyond a certain horizon. So that introduces more riskiness. For credit, we set the threshold at lower rated entities, and so on and so on. For other indicators, we just do simple sum. So whenever we can, we do simple sum, simple averages, because it helps us with the explainability of the data and with the, do you say checkability? I don't know. I don't know what is the word in English, but with the ability to check and eyeball whether something makes sense or not. Because this is a huge spreadsheet, if you can imagine. Okay, so how do we do? We standardize, compute average risk scores, we put it all in a standardized and comparable form until we come up with an impact score and a vulnerability score. We didn't want to merge those in a number because both the impact and the vulnerability are important, so we put them in a matrix form so we can keep sight of both. And we consider whatever is red as we need to do something, and whatever is amber is let's keep an eye on those, so close monitoring. And this is really how we get to the watch list. Here, just to give a bit of a sense of the data, we have about, so now I think it's quite common knowledge that non-bank financial intermediation now represents about 50% of the whole financial intermediation. In Hong Kong, this is a bit smaller, but still we have a decent set of about 700 billion US dollar of NBFI positions in equity, in OTC derivatives. So we give you a bit of a description here. So on the left panel, we can see that the main category of exposure for NBFIs is equity. This is not true in the whole of the data, but for NBFIs, it's mainly equity and then followed by FX and IR. Second chart basically tells us on the y-axis we have the concentration indicator, and it tells us that by and large NBFIs are more diversified and less concentrated. Chart on the right puts volatility and small cap. If we look at the red dots, they tend to be more in the middle, whereas the green dots can be really far out. So they can really invest in small cap stocks or in high volatility stocks. So we see quite a lot of those potential archegos. How do you discriminate about them? We could give you probably 800 of those. So at some point we need to find a mechanism to sift through them. Interconnectedness, most of the NBFIs have 1 to 5 counterparties, but actually we have a number, almost 200, between 6 to 10 counterparties. So 6 to 10 prime brokers, very similar to Archegos. And we also have a number of NBFIs with more than 10 counterparties. And finally, on the right-hand side, we do a bit of, simple network analysis. The purple dots are the 12 major prime brokers. The blue dots are the NBFIs. And when we see links that are in red, it means they are very large exposures, and they are large for the prime broker. So we see the red are basically exposure. For the prime broker, the exposure to that NBFIs is more than 10% of all the exposure to the NBFI. So we tend to think about the prime broker really diversifying, but that is not always the case. Finally, macro environment. This is our multiplier. We multiply whatever we get at the end by a higher scalar if there is a lot of volatility. So you can see that some NBFIs could be flying low in the green area, but then actually when volatility shoots up, it actually brings up our NBFIs because they will be more exposed to volatility, their portfolio could be more exposed. And also about, like Warren Buffett said, when the tide runs down, that's where you see you swimming naked. So this is to capture this factor. 2 minutes, so I will conclude very quickly. This is the watch list. So far, we have never had someone who's read on both dimensions, so far we keep a close eye. But we have done some back testing, and we had a number of quarters now, so since Q3 2021. And number one, so for example, in this example, in the blue, if you see a blue box around those dots, that's the same MBFI. Q3, it was number 3, Q4, it was number 8, then it disappeared, it had reduced its exposure, okay, happy times. But then actually in Q2 2022, we saw it mentioned in some legal proceedings linked to Archegos in particular. And that was, oh, that's interesting. So it had helped us about 6-9 months earlier to study about who they were, to learn about their portfolio, to start to keep an eye on them. And similarly, the green one was another one that we started to see in Q1 2022, and then it went up in Q2 2022, and then we saw that we read in the news that some market counterparties had stopped trading with them. So this proves to us how it's useful to us. And also we did some back testing with Archegos. So if we had all the information that about Archegos positions, it would have featured as number 1 on some of the indicators, not on everything, but on quite a few. And we equip something at the very last line, which says, this proves that the framework works, but only as long as comprehensive data are available. So someone else here was making the point that at the moment, the data are fractured across jurisdictions. We don't have access to all the data. We would love to be able to share some red flags about these MBFIs, because ultimately someone needs to join the dots. So I'll conclude now. So number 1, limitations of the framework. I've been very upfront. Measurement error, model error, everything here could be modified, could be improved, as long as what matters for us is the explainability and the ability to cross-check that something makes sense. So we don't want a black box approach in which we don't know how to explain what's going on. And we also focus mainly on first-order effect. We're not trying to model very complicated second-order effects. And we aim to continuously improve it in an iterative process, so keen for suggestions. So finally, I want to give 2 takeaways. So for us, number 1, the granular data have been really a game changer, because the ability to reconstruct positions of who's in the market, despite the data gaps, really helps us put in context. So I really like the presentation, the earlier presentation on the insurance by Gabor, because we're doing exactly that, in which we take the insurers, we take the pension funds, we take the private credit firms and so on. We act in limited information, but it's good to try to model those flows between the entities, because they're really interconnected at this stage. And the second point is that we have lots of data, and we need to find, albeit imperfect, but we need to find ways to coalesce those data and to let it serve us, basically, to start to enter risk assessment. And I will conclude here, and thank you very much.
Thank you very much. Sylvia, I just realized that Sylvia is not maybe a name for a man. So, isn't it? Silvio? No?
No.
No, okay. I should stop this discussion now, I have a feeling. Let's go to some other questions instead. Yes, please.
The lesson that most of us took away from long-term capital management was driven home in September of 2006 with the failure of Amaranth Partners, which my guess is very few people here have ever heard of. Amaranth Partners lost more money faster than LTCM, but it was trading centrally cleared derivatives, while LTCM was trading OTC derivatives that were not centrally cleared. So I found it interesting that you didn't distinguish between centrally cleared and not centrally cleared. And also, if Archegos it had been forced with its total return swaps to centrally clear them, the positions would have been known. So the question that I have is, what's the relationship of what you're doing to central clearing, which is what was supposed to actually reveal through the trade repositories and everything, if we have, because we only have two real big clearinghouses, one's in London and one's in Chicago. And we have the data available in principle for that. But what's the relationship of this to centrally cleared derivatives? And why are we using the central clearing data and the margins there to tell us that there's less risk?
So let me try with this. So central clearing, number one, it's only interest rate that tend to be centrally.
Commodities, equities,
but very little.
CDS,
But
FX.
So my understanding of what we see is that we tend to see more central clearing in interest rate because of the mandate to clear interest rate swaps. That's what we see. And there is then some, say, NDF in the FX space that are centrally cleared. We do see, so if you like the interest rate, 40% weight, much lower, I guess it incorporates some of that central clearing. But for me, central clearing is more like the policy response. So there is a risk, so the policy response is to say, hey, clear it with the central counterparty so you diminish the credit counterparty risk. So it's the solution rather than than a symptom.
They're centrally clearing commodities too. That's in Chicago. But they are centrally clearing. It's not a response. It's not a response, it's the current standard. That they're centrally clearing a vast percentage, like 70 or 80% of all of the gross notional outstanding in the world.
I would argue from what I see in our data that that's true of interest rate swaps and of some FX like NDF, but it's not totally, it's not universal in other asset classes. And it could be because of the data we have, because they are data on the Asian time frame. So I don't know how the data would look like if they were centered around two of the major CCPs. But we don't, so you prompt me to think we could incorporate something about central clearing, which we give reduced weight to those centrally cleared exposures. And that would really touch the interest rate data for us. Because given the, I'm familiar with what the data look like, and you would only see it in interest rate for us. But it's a good suggestion about the risk, assessing the riskiness. Thank you.
Let's time for one more question.
First, a comment. I'm very, very happy to see what you have done in Hong Kong. So this is very remarkable work, and I think it's a good example to others as well. So many thanks for presenting. I actually wanted to ask, so normally liquidity and leverage are the key risks for NBFIs. So I didn't see liquidity indicators or many of them, or maybe I was sleeping, but I don't know if you have them. And then also indeed on leverage, so it is a challenge for everybody to how to measure it. So if you have any thoughts, are you thinking of the synthetic leverage using the derivatives, that type of things? I guess you are. And finally, on the TR data, which we all try to understand better, are you there also looking maybe AI methods to identify some odd behaviors or odd positions, or if you have been thinking about that direction as well? Thanks.
Okay, let me try that. So on liquidity is actually central to our definition of portfolio characteristics, because the reason why we identify, so liquidity is great because, or rather it's great, basically it's there and then it's not there. So when you need it, it's not there. So that's why we have the last indicator is liquidity, the existing liquidity, but how do we project the forward-looking liquidity when something goes wrong? And that's why we have done a lot of modeling on portfolios that are on small cap stocks, on substantial interest stocks, precisely to anticipate that forward-looking element in which liquidity immediately evaporates when you need it. So the whole of the portfolio is actually about liquidity. Now, on leverage, we do not collect data on margin, unlike the EU framework, but we have in the plan to collect data on margins. So it's one of our plan, and recent work actually has been very useful to bring up the emergence or the usefulness of those data, and including by the ECB and the ESRB. So yes, we look forward to that. And AI, do we use AI to spot out behavior? Not yet. I would love to. I'm trying to think about how to do it, but I haven't got the hang of how to do it yet. So it's probably the next chapter in the journey.
Thank you very much, Silvia. Now we are a little bit behind schedule. We take a 15-minute break. We can be back 25 past, so we have also time to make it to the ferry, those of us who will go to the Suomenlinna. So we don't have time for a longer break, unfortunately.
Okay, dear friends, let's try to start the last session of the conference. It's always a challenge but we have actually two excellent papers still left. So first, Dmitry Chepotarev from Indiana University will talk about the paradox of conservative haircuts. And the second paper is by Tristan Jorde on systemic climate risk. So let's hear the two gentlemen, and let's invite Dmitry to the stage. Thanks very much.
Hello. Thank you very much to the organizers for making this happen, and thanks for putting my paper on the program. So this is a paper titled The Paradox of Conservative Haircuts, and one session chair in one conference before told me that Googling conservative haircuts, trying to understand what it is, he found the photo of Donald Trump. So understanding that there is a bit of uncertainty what this means, I will announce that this is a paper about the effect of collateral requirements of central counterparties on the trader's market choice. So central counterparties are financial intermediaries that exist to mitigate the counterparty credit risk. If we think about a simple bilateral market, the traders take risks bilaterally, and if one trader defaults, the other is affected. However, in centrally cleared market, the CCP, central counterparty, separates the initial transaction into two back-to-back deals, each done with the CCP itself. If now one trader defaults, the other is not affected, as long, of course, as the CCP itself is resilient. And if we imagine several deals going through the CCP in all different directions, it becomes apparent that CCPs are concentrating risks and therefore are systemically important. And now when the centralized clearing is spreading both across contract types and globally, it's important to understand whether or not these CCPs are financially resilient, for as this quotation suggests, it won't be a good outcome if the CCP defaults. But if we look at the empirical evidence about the stabilities of CCPs, we don't really get too much. They're not that numerous, and the cases are not also numerous. So in certain cases, we can say that CCPs are efficient in conducting resolutions of failing counterparties, or when the centrally cleared markets act as shock absorbents when the rest of the economy is stressed. But there are also some quote-unquote recent historical cases when the CCPs defaulted, and certain, one can say, close calls. For example, when the default probability of a European CCP clearing repo was big enough to be priced in by the market participants in the repo rates, or a more recent case when Nasdaq clearing commodity was actually quite close, using up to 60% of its guarantee fund, trying to resolve a certain case. So then, how well are the CCPs protected by their risk management systems? What can be the challenges that they have, and how can we address them potentially? And to be honest, the risk management system of CCPs is quite comprehensive. It's quite complex. So first of all, there is individual collateral. Initial margins and variation margins, they all go here. Then there is the guarantee fund, which is a mutual collateral. It works as an insurance, as a risk mutualization device, meaning that if we all trade, if we're all CCP members, we all put money in a guarantee fund. And then if somebody defaults and the initial margin is not enough, then this fund can be used to cover the losses inflicted by any of us. And finally, there is the dedicated capital of the CCP, also known as skin in the game. So the story today will be mostly about the individual collateral. So important to know what the common wisdom suggests about the use of this collateral. Typically, we say that the more collateral the CCP requires, the better it is. Well, at least for the CCP. So when there is more collateral, first of all, you give less incentives to default to the market participants. They have their own, so to say, skin in the game. And secondly, if I'm a CCP and I have a lot of collateral, somebody defaults, I sell collateral, I cover the losses. So especially given the place where I'm presenting right now, I'm going to pose sort of a heretical question, whether there is a downside of asking too much collateral, whether or not this can actually backfire, in what cases, and whether we can see some evidence of that. And the answer that I will try to carefully suggest here, that there is a selection effect. When the collateral requirement of CCP becomes excessive, of course it pushes some traders out of the market, but more importantly, it first pushes the safest traders out of the market. And this can actually affect the risk mutualization component. So let me explain to you what I mean and how this can happen. So suppose that there are two markets, the centrally cleared and the over-the-counter market. And let's say that there is a set of traders that are free to choose where to trade, meaning they are admitted to both markets. Let's assume that for some reason those to the right of the red line go to the over-the-counter market and those to the left go to the CCP market, just without any explanation for now. Now suppose that, and that's an important thing I should say, in the over-the-counter market, all parameters can be negotiated bilaterally, including the collateral requirements, but also including other features of the deal. While in the centralized market, collateral requirements are set by the CCP itself because it takes the risk, right? So suppose that the CCP decides for some, let's say, exogenous reason to increase the collateral requirements in the centrally cleared market. What happens is everybody in the CCP market get affected. For them, trading costs suddenly increase. Now, probably some of them will think that now trading in the CCP market is getting too expensive and may want to switch to the over-the-counter market, and let's assume that some of them actually will go to the OTC. Now then, the question of what is the effect of the increase in the collateral requirement on the composition of traders boils down to comparing the green switchers and the blue non-switchers. Or equivalently, if I can show that the quality of traders before switch, which is blue plus green, is higher than the quality of those who trade after the switch, which is blue, then I can say that the increase in the collateral requirements of the CCP pushed the best, the safest traders out of the centrally cleared market. Now that's exactly what I will be trying to show empirically, but the first point here will be, okay, so what? And the idea here is that the CCP increases collateral requirements, strengthening the individual collateral component, getting more collateral, but on the other hand, if it pushes the safest traders, it might weaken the guarantee fund, because if it is an insurance, if you push the best agents out of the insurance, the quality of the insurance deteriorates, right? Therefore, potentially, when strengthening the individual collateral, the CCP might weaken the mutual collateral and therefore affect its own stability. Now, the data that I will be using will be coming from the interbank repo market, and I know that most of people here are more knowledgeable in about the interbank repo markets than I am, so I won't go into too much detail here. So if everything is fine, the loan is repaid, the collateral returns to the owner of collateral. If not, there is liquidation netting. Collateral is sold. The excess amount, which is left after selling the collateral, is transferred by the lender to the borrower. And how can it be that there is an excess amount? Well, that's because of over-collateralization. Typically, collateral is worth more than the loan, than the amount borrowed, upon the origination of the loan. And the over-collateralization I will measure by the haircut. Okay, so this is an empirical paper, and there will be 3 main empirical results. So first of all, I will show the risky borrowers are more likely to borrow in the centrally cleared market as opposed to the over-the-counter market. Also, first of all, now that we know that we're talking about the repo, we know what risk we're talking about. It's the risk, the credit risk of the borrower. This is the risk that is more commonly spoken about when we think about repo. And here, this is a statement about the allocation of traders with respect to this red line even before the CCP starts doing something. referring to the diagram before. I will also try to argue that it's lenders' risk preferences that affect the borrower's allocation across the market. I'll try to show why. Now, the second and perhaps the most important result is that higher CCP collateral requirements push the safest traders out of the CCP and into the over-the-counter market. And this will be the statement about comparing blue plus green to just blue. Now, if time permitting, I will try to show that there is a bit more color to the story than just dark blue and just dark green. For example, the collateral constraints of the borrowers actually matter. And since it is likely that I won't have time to go into detail here, the logic is the following. So suppose that I am a borrower, and yesterday I borrowed from one of you, and I have a lot of free unencumbered collateral still. So tomorrow you ask me to borrow with a high haircut, that is, to collateralize a bit more the deal. Well, if I have a lot of unencumbered collateral, I just add a bit more and roll over the deal without problems. Now, suppose that today I have already pledged everything that I had. Tomorrow you will ask me to increase the haircut, but I can't create collateral out of the blue. Therefore, I can, against the same collateral, borrow less money. For me, this is a liquidity shock. Therefore, my collateral constraint will depict how sensitive I am to the change in collateral requirements set by you. Okay? So therefore, we can see that collateral constrained borrowers will be more sensitive to the changes in collateral requirements. Of course, what I would love to be able to do is to say I measured the default probability of the CCP itself, and I can say whether or not the increase in collateral requirement of in the individual collateral requirement, that is, increases or decreases or keeps unchanged the default probability of the CCP, but the truth is I cannot measure it in my data. What I can do instead, I build a theoretical model in the appendix of my paper, and I show that theoretically it is possible that an increase in the collateral requirements of the CCP actually increases its default probability, and that it happens exactly when the CCP is already over-collateralized, and then starts further increasing the individual collateral requirement. Then this is possible. But this is only a theoretical result. I can't really demonstrate it empirically. All right, so for the sake of time, I will skip the related literature, but feel free to ask questions if you are interested in it. So what kind of magic data can allow me to compare the CCP and OTC markets, since there is no such data set, at least anywhere else that I'm aware of? So this data is coming from Moscow Exchange, and this is a remarkable data set in a sense that one can see who trades with whom, the collateral, the rate, the haircut, the date, literally everything except for what happens with this deal after. So the ex-post performance of the deal is unobservable. And this data is connected to banks' financial reports with their balance sheets and the historical credit ratings by Moody's, S&P, and Fitch. And this is through remote access. So I don't see who the counterparties are. I write the code, I write all the regressions, and I only get the tables. So it's like a very complicated way of carrying out an empirical research project, but that's the only way that I can work with such interesting data set. And the idea, the uniqueness is that usually we do not see anything about the OTC market. Here, the reason why we see what is happening in the OTC market is that Moscow Exchange made a platform that is quite well used for the over-the-counter repo, because in this platform, this platform is very convenient for over-the-counter trading. So most of the over-the-counter repo deals are registered within Moscow Exchange, so they see what is happening there. Now, another interesting thing is that the data set on the CCP side is composed of two parts: the bilateral segment and the exchange traded CCP. What does that mean? Bilateral is very similar to the over-the-counter repo. As in over-the-counter repo, the traders contact each other over the phone or through the terminal, but then decide that this will be done through the CCP. Exchange traded is completely anonymous. It's a limit order book. So we can actually see whether this anonymity plays a role. I'll try to show you. Okay, so credit risk is derived from the credit ratings. Now, let's go to the results. So the first step is to see whether, what is the effect of the credit risk on the location of borrowers across the markets. Or otherwise, I will ask you, where would you expect to see a riskier borrower, in the centrally cleared or over-the-counter market? It turns out that theoretically there are different ways to look at it. It can be either way, right? I'm not going to go very deep in this argumentation, but for example, if there is a lot of asymmetric information, the CCP can solve as a part of a separating contract, and you will see safe borrowers borrowing in the centrally cleared market where the haircuts, collateral requirements are higher, where they can signal their type by posting more collateral. Alternatively, if by contrast CCP is more of an insurance device, then borrowers and lenders, they meet, they interact, and the risk-averse lender can decide to trade with risky borrowers in the centrally cleared market because the centrally cleared market provides insurance against idiosyncratic risk. In that case, we will expect to see risky borrowers in the centrally cleared market. So if I test this by running a regression of whether the deal is centrally cleared or not, on credit risk, controls, the borrower fixed effect, and the collateral month fixed effects, I can show that the credit risk, that when the same borrower becomes more risky, she is more likely to go trade at the CCP. So this is consistent with the idea of CCP being an insurance device, and I can further show that this effect comes mostly from the bilateral CCP segment. And the idea is that when the borrower and the lender meet directly and see who is trading with whom, then they can condition where the deal goes to the centrally cleared or over-the-counter market on the credit quality of the borrower. So the risk-averse lender can say, okay, I'm fine trading with you, but please let's do it with an insurance. Then where the deal goes depends on the credit quality of the borrower. And this is actually in line with the Holmström and Tirol idea of the interchangeability between monitoring and insurance. You have insurance, you don't care who you trade with, right? This is something that should be relevant to regulators when deciding whether or not the centralized clearing should be anonymous when the over-the-counter market still exists. Okay, so let's go to the main result. And here I will try to show that this has something to this has implications for the CCP adjusting collateral requirements. Meaning that when the CCP moves the collateral requirement, increases it, it kind of pushes everyone away. But those who are safer, they're more welcome in the over-the-counter market. Lenders are more likely to trade with them in the over-the-counter market, therefore they will be the first to migrate. So here, for identification, I will use the gap between the centrally cleared and the over-the-counter collateral requirement. And the idea is the following. CCP haircut, CCP collateral requirements are collateral specific, while over-the-counter collateral, over-the-counter haircuts are collateral and borrower specific. So how do I know about the first point? Well, there is a methodology. Another uniqueness of my data is that the CCP decided to post the methodology on the official web page, which very few CCPs actually do. And we see there that CCP does not condition collateral requirements on the identities of traders, which is important. So therefore, of course, in both markets, what is happening to the security matters. But in the centrally cleared market, the identity of the borrower does not matter at all. So there we have a methodology. In the over-the-counter market, you can say we have an aggregate methodology, an aggregate view of the market on what the collateral requirement should be. So I take the gap between the average collateral requirement in the CCP and OTC market, And I use the variation of this gap as a proxy for the overreaction of the central counterparty to the security-specific news. So I take the collateral requirement, I take the credit risk, I average at the collateral month level, and I start with a simple regression of the difference in credit risk on the difference in haircuts. The result is positive, which is in line so far with the increase in CCP haircut driving the increase in the credit risk of the CCP. But this is just difference regressed on difference, while, for example, we want to know whether it is the CCP haircut or the OTC haircut that is driving it. Well, let's decompose the exogenous variable into components, and then we see that most of the effect is coming, well, all of the effect is coming from the CCP haircut. Okay, good. Now, we also want to know whether the effect is coming through the credit risk in the CCP market or OTC market, right? So the left-hand side variable, the credit risk, can also be decomposed by the markets. And if I do that, I can show that actually, and that's exactly what we expected, when the CCP increases its collateral requirement, the credit risk of those who trade with this security in this month in the centrally cleared market increases. High collateral requirement, more risky borrowers. Okay? Interestingly, in the OTC market, the credit risk decreases. So this is actually in line with the safest of those who trade in the centrally cleared market being also safe even for the average level in the over-the-counter market. So these safe guys will be the first to flee to the OTC market. Okay, so and that can be also seen in the univariate regression. Okay, so I do another simple test here. I try to isolate the variation that is coming, the variation in the haircut differences that is coming from the CCP haircut, and well, the result is a bit stronger and more statistically significant, but that's just another verification of the same thing. So I think, yeah, I have 2 minutes, so I won't have time to talk more about the financial constraints, but in brief, first, I show that in the over-the-counter market, when you are a borrower who is more collateral constrained, you have more incentives to bargain for a lower haircut, even at the cost of a high interest rate. And this is quite statistically and economically significant. Now, then, knowing this fact, I go to our previous result, and I'm asking, out of all safe borrowers, which borrowers are more likely to react to the change in collateral requirements? More collateral constraint or less collateral constraint? And it turns out that these are the most collateral constrained guys. Okay. So let me conclude on that. Higher CCP margins induce the best traders shift from the centrally cleared to the over-the-counter market. This is the result that, if I want you to remember one thing out of the presentation, this is the result that I would like you to remember. Just a clarification on the point of the data is that it's not that I'm trying to say that the market that I study is the market that should be of big interest per se to everyone, or that it is very much similar to any other market, but it is a great sandbox for studying a particular selection effect, because there I can observe all the moving pieces, and at the same time it gives a very good overview of what will happen if, for example, in the repo market in Europe, we admit all the traders to the centrally cleared repo market, keeping the over-the-counter market fixed. Thank you very much. I'm looking forward to your questions, and yeah.
Intuitive results, and we can definitely confirm that we observed during the energy crisis, for instance, that people moved to the OTC market. And I think with European data, we would be actually empirically able to test it. So let's see if we can collaborate at some stage. I will give you the floor.
Just a quick question, a quick idea, very nice. Do we need an individual collateral in a CCP with a collective agreement, collective arrangement?
Sorry, can you repeat, please?
Sure. Do we need, given your setup, an individual collateral requirement for a CCP when you also have a collective insurance?
So here in the repo deal, the collateral will be the security itself. Also, the lender actually will have to provide some collateral if the lender wants to withdraw the security. And there will be on top of that still the guarantee fund. So all the layers of collateral will be present even in this case. And this is pretty common. The interesting thing is that if you look across jurisdictions, across types of CCP governance and across countries, you will see a lot of heterogeneity with how this thing is modeled. There are CCPs where there is no individual collateral indeed, but only mutualized collateral. For example, DTCC in the United States. There are other cases where members can move collateral from the guarantee fund to the individual collateral, which is, for example, ICE Clear Credit. So there is a lot of heterogeneity there, but the whole structure is usually the same.
I have just a technical question. How many counterparties do you have in the data? How many institutions and how many lenders and borrowers?
So in the sample that I keep in the interbank market, I think it will be around 60 to 80 banks that will stay after all filtering.
Thanks. Really interesting. I had one question. So, would it be able to look into how parties moving to different platforms, how that changes the composition of lending? Because, one thing is, of course, your core question is, what's the stability of the CCP framework? But another is, what are sort of the financial or subsequently the real effects of parties moving to different platforms and thereby maybe changing the composition of their borrowing. So, one possible outcome is, if I go to an OTC rather than a CCP, I might borrow there or lend there, but I might borrow and lend less. And that would be interesting to understand if you could address that question.
Yeah, thank you. I didn't think about it, but I guess I can look at it actually.
So very nice presentation, thank you. I think you were pretty convincing in showing us that higher margins in CCPs led to lower quality borrowers in the CCPs, but you didn't, or maybe I missed it, I think you didn't show whether the increasing collateral was enough to compensate for this poorer quality of borrowers. So can you compare both effects and see which one dominates?
So you're completely right. That's actually the point that I tried to make on this last part of the slide. So I cannot compare it because that would. I don't know how to do it, and I cannot measure the default probability of the CCP, so I cannot see how it affects. I do it theoretically, so I build a model in which both effects are present, and the allocation of traders across the markets is endogenous. So is the collateral requirement in the over-the-counter market and the interest rate. And theoretically it is possible, but whether or not it takes place in this particular setting, I'm unable to say. That's a good and that's a valid point.
Okay, I think we have to move on to the next presentation, so let's give a big applause to Dimitri. And the last presenter of the conference, definitely not the least, is Tristan's presentation, so please. Well done.
Well, hello everybody. I'm really pleased to be here to present this work on systemic climate risk. So it's a joint project with Quentin Moreau from University of Glasgow. And what we do in this paper is two things. So first, we develop a market-based framework in order to understand whether investor priced systemic climate risk as a systemic risk for the financial sector. And then we apply this framework to a sample of European financial institutions. Just to give you a very brief introduction, so I wanted to remind that McCartney was among the first to warn that climate risk could be a financial stability issue for the financial sector. And since then, most central banks have included the climate risk as a key vulnerability into their financial risk assessment, including the Fed in 2021. So here you have a chart that represents our main assumption, the organization of the framework. So the basic idea is that climate risk, both transition risk and physical risk, will first affect the non-financial economic sectors through, for instance, the damages to properties or business interruptions. And only then financial institutions might be impacted through their portfolio exposure to non-financial institutions, companies. So this is what we call the first one effect of climate risk. And once some financial institutions have been impacted, there might be some amplification mechanism, some contagion effect due to the strong interconnection network between financial institutions. And we call that the second one effect of climate risk. So in this paper, we study both the first one and the second one effect of climate risk. But the paper remains silent on the feedback, the potential feedback loop between financial institutions and the economic sectors. So we focus on the three circles on the right. So yeah, we developed the market-based framework in order to to explore the effect of the first one effect of climate risk and the second one effect of climate risk on the financial sector. So again, the second one effect of climate risk are the contagion effects. And here we use a broad definition of contagion. This is the one of Nissen. So this definition encompasses the exposure to common shocks, the spillovers between two financial institutions, and the pure contagion that might arise from the behavior of investors, like a common rise in risk aversion, something like this. So in this paper, we addressed the following question: which are the most vulnerable financial institutions? Can climate risk generate contagion effect among financial institutions? And also, is it possible, both for financial institution and policymaker, to take action in order to reduce their exposure to climate risk? So let me give you some intuition on the fact that we use a market-based framework. It is quite simple. That is that climate risk should lead to a repricing of most of the financial assets. And these financial assets are held by financial institutions. So the purpose of the paper is to explore whether climate shocks are reflected into asset prices and whether they already propagate to financial institutions and also among financial institutions. So we take the perspective of an investor, and this perspective differs from the one of the regulator that is based on long-term forward-looking scenarios that are also subject to uncertainty. So we consider that our framework complements the other one, and it allows to develop a dynamic monitoring tools in order to check whether investor priced climate risk as a systemic risk for financial institutions. So the framework is the following. First, we design some inputs, a systemic risk measure and some climate risk factors. And then we will use these inputs into a regression framework in order to test whether climate risk has an effect on the systemic risk of the financial sector. And finally, we look at the potential actions that financial institutions can take to reduce their exposure to climate risk. So we just look at the determinants of these exposures. So first, regarding our market-based measure of systemic risk. So there are two elements in systemic risk. The first one is individual tail risk, and the second one is contagion effect. So regarding the individual tail risk, what we do is that we use the equity returns of financial institutions, and with each of these time series, we use a Garch model to estimate a dynamic value at risk. And once we have the individual dynamic value at risk for all institutions, we look at the contagion effect. So we extract the covariation between all these dynamic value at risk using a PCA analysis. And our main measure of systemic risk is the first principal component from this PCA analysis that you can see here, and that tend to spike during the main systemic events that occurred over the past decade. And so this measure is related to many other systemic risk measures in the literature. We are not saying it's a better measure, but it is better suited to the purpose of our study, especially to distinguish between the first one and the second one effect of climate risk. So then we designed some market-based climate risk factors for the non-financial companies. So this factor aims to capture the effect of climate shock on the value of the non-financial firms. And we used a standard approach in the asset pricing literature, that is to design a long-short portfolio. So using an environmental characteristic, we sort firms into a brown and a green portfolio, and our climate risk factor is just the difference of the returns of the brown portfolio and the green portfolio. So we designed two climate risk factors. The first one is a transition risk factor, and for this we used the carbon emissions, scope 1 and 2 of each firm. And for the physical risk factor, we used the firm level physical score of true cost. And finally, for consistency with the first step, and also to reflect the extreme climate shock, we also estimate the dynamic value at risk of this factor, and this is what we are going to use in the regressions. So we check the reaction of the factor to some different type of climate shocks. And what you can see here is that for the physical factor, it tends to have negative returns when there are some natural disasters, which means that brown companies tend to underperform the green companies in these events. And for the transition risk factor, we find that it exhibits negative returns when there are high abnormal temperature and a lot of climate news. Which again means that the brown companies tend to underperform the green companies in these cases. So once we have the two set of inputs, we use them into a regression framework. So we design a procedure that exploits both the time series dimension and the cross-sectional dimension. For the time series dimension, it's quite simple. We just regress our measure of systemic risk on our climate risk factors plus some control variables, and I will go back later on the cross-sectional approach. And the final step of the framework is just to see whether a financial institution can take action in order to mitigate systemic climate risk. So we look at the determinants of their exposure to climate risk. Both financial and extra-financial determinants, and we specifically look at the indirect carbon emission, so the scope 3 of financial institutions that represents the emissions that are emitted by the portfolio of the financial institutions. So we contribute to 3 strands of the literature. The first one is developing quite quickly. It is about the integration of climate risk into asset prices. So here we develop a flexible framework to explore the effect of climate risk on the tail risk of the equity market. And we said that the framework is flexible because here we apply it to financial institutions, but it could also be used for different sectors, different asset types, and so on. I think our main contribution is about the effect of climate risk on financial stability. So the empirical paper here look at the effect of climate risk, the first one effect of climate risk on financial institutions, and we develop a procedure to explore the second one effect of climate risk on financial institutions. And finally, we also look at the determinants of the climate risk exposure of firms. So there are some papers looking at this, but they tend to use climate risk measures that are based on accounting variables or like news, earning calls, things like this. Here we studied a large set of determinants of a market-based measure of tail climate risk. So the data we use goes from 2005 to 2022 for all the European Union plus some countries. We follow more than 300 financial institutions from different subsectors. And in order to build our climate risk factors, we use thousands of active and dead non-financial European stocks. So for all these stocks and companies, we download a lot of data. I will not detail everything, but just for the environmental data. So for carbon emissions, Scope 1 and 2, we use a data stream. For the Scope 3, we use Carbon for Finance. And regarding physical risk, so it is again a firm-level measure of physical risk, we use true cost. And as an alternative variable, we also use the data that is provided by ISS ESG and Carbon for Finance. Regarding the control variables, which are very important in this study, since we are using equity data, we first use the main risk factors that have been proposed in this literature that are systematic risk factors. So you have the size, the value, the momentum, and so on. And these factors are supposed to capture a different set of bad times. And we also add some more standard macroeconomic and financial variables, such as the default premium or the interbank market liquidity. So these are the results for the first one effect of climate risk on financial institutions. Here we develop some kind of climate exposure cover measure. The idea is to look at the sensitivity of the tail risk of the financial institutions to climate risk. So we just regressed the dynamic value at risk for each financial institutions on our climate risk factor. Again, it's the value at risk of the climate factor. Plus the control variables. We aggregate the result for all financial institutions using the mean group estimator of Pesaran. And as you can see on the chart on the left, which is the coefficient for the transition risk factor, it's significant and it has been increasing over time, while we do not see anything significant for the physical risk factor, even if there might be some kind of positive trend also. So we can do the same thing for different type of financial institutions. Here again for transition risk, and we see that the trend is mostly positive for banks and for life and non-life insurance. Now these are the results for the second one effect of climate risk on financial institutions. So again, we exploit the two dimensions, the time series and the cross-sectional dimension. So for the time series, it's quite simple. We use our systemic risk indicator, which is the covariation between the tail risk of the financial institution, and we regress that again on our climate risk factors. For the cross-sectional regressions, here the idea is to look at whether the financial institutions that are the most exposed to climate risk also contribute more to global risk. So how do we estimate the contribution to global risk? We just take the weight on the first principal component, and we regress this weight, so this contribution to global risk, on the previously estimated exposure of each financial institution to climate risk. So again, we have done that here. So this is the exposure to transition risk and to physical risk. So these are the results. BMG is for transition risk, VMS is for physical risk. So what we have here is that we find a significant effect of transition risk on systemic risk, while we do not find anything significant for physical risk, and the coefficient is even negative. We check the magnitude of the effect of transition risk. It tends to be moderate, but it's still very significant. And yeah, the results are robust to many different set of control variables. And here we also use some fixed effect for country and industry, and we cluster standard errors, so which means that the results tend to hold also within the industries and the countries. And now this is the last part of the framework. So we look at the characteristics that are correlated with the exposure of financial institutions to climate risk. And we find some interesting results. So first, we can see here that the larger the institutions, the higher the exposure to transition risk, which is in line actually with the climate stress test of the ECB for banks. And we also have a set of quite intuitive results. So for instance, we find that the cleaner the portfolio, the lower the exposure to transition risk. Also, when the emission have been checked by a third party, and when the financial institution has reached its reduction target, it leads to a lower exposure to transition risk. And finally, we find that when the financial institution is long-term oriented, this also leads to a decrease in in transition risk exposure. For physical risk, we do not find that many significant things. Still, there is something interesting here. We find that the larger the financial institution, the lower the exposure to physical risk, which just makes sense because large institutions have more ability to diversify its assets across different areas. So I will skip this part and go to the robustness test. So of course, our result here could be data dependent. So we have checked for alternative risk factors. So here we develop a transition risk factor that is not based on the carbon emission scope 1 plus 2, both estimated and reported, but just the scope 1 emission only reported by companies. Here we find a 90% coefficient correlation between the two factors, and the results are unchanged. So it seems to be quite robust. For the physical risk factor, it is another story. So we use true cost, ISS ESG, and carbon for finance, and we only find a 26% correlation between the three factors. So it means that there is a large disagreement between data providers, and yeah, it could just lead to a dispersion of flows. So it might make sense if investors are unable to price physical risk as a systemic risk for financial institutions. But still, in all the cases, we find non-significant results for the physical risk. So just to conclude, we have built a market-based framework to identify the financial institution most exposed to climate risk, and also to detect potential contagion effect that might arise from climate risk. We find that transition risk has a significant effect on systemic risk, while we do not find any significant effect for physical risk, at least for now, because it could be used as a dynamic indicator. We have some quite intuitive results. So the cleaner the portfolio, the longer term the orientation of the firms, the lower the exposure to transition risk. And finally, so again, we could build a dynamic indicator to monitor this effect over time. And the framework is flexible, so it can be used to different countries, different sectors, different asset types. And finally, it could also be used to assess the effect of some emerging threats to financial stability, just by replacing our factors of climate risk by other type of factors, such as for cyber security, for instance. So that's it. Thank you very much.
Okay, let me check first if anybody else than Steve wants to. No, it was a joke.
Quick suggestion. I mean, again, you know that Bob Engel is very active in this area too. So there is this paper, C-Risk. Since you haven't cited, just I suggest you to look at it because any referee would do it.
Thanks for the good point. Anybody else wants to have a comment?
Thank you for a very interesting presentation. I guess what I'm trying to understand is like the time scale that you're looking on for the physical risk. If I looked at the axis, it started in 2014 or 18. Like it seemed quite recent, like where the back end of the data, or where did the data start from?
So the data goes from 2005 to 2022.
Yeah,
and it's at a monthly frequency.
Right, because that is what I was a little bit interested in. Because for transition risks, I mean, this is basically about like the whole market needing to transition out. I mean, we expect that to happen on some sort of scale. But for physical risks, like if we imagine that there wasn't really like a climate effect taking place, we would still have physical events taking place, but that would just be sort of priced in. So the physical effect, right, is a lot about things becoming more frequent. And that was my question on from a little bit of a fundamental point of view. It would be interesting to correlate what you see on the physical factor versus sort of more objective, how the risk level has changed over this period of time.
Yeah, thank you for this great point. So actually, I think we can answer that a bit. So what you are saying is that the frequency of these events is increasing, and potentially the sensitivity of investor to physical risk can increase also. So this is why here we just run some dynamic regressions with a rolling window that is able, I mean, to assess a potential change in sensitivity here.
One more, if anybody wants.
And just maybe regarding the C-risk comments, yeah, I'm well aware of the paper. I think it's just that they mostly look at the first one, effect of climate risk, and here we just propose a new procedure for the second one, effect. I think it's the main difference between the two papers.
So if I understood correctly, the way you compute the climate risk is by ordering firms by exposure to high exposure to brown versus low exposure to brown, and you take like the difference in the return of this type, the top most exposed versus the top less exposed. And if you do this, maybe you're capturing something else, because perhaps the most exposed are manufacturing, the least exposed are services. So then maybe you're capturing something else than exposure to climate risk. And maybe a solution could be to try to project out this factor on other things, so that what you are left, you ensure that you are not capturing manufacturing versus other things, or is this something that could be done?
No, it's a very valid point. We checked how much our factors are diversified, so I don't think we have this in appendix. We just check. No, it's not here. No, actually, since we take the carbon emission intensity and not the carbon emission in absolute value, we still find it's still quite diversified between all industries. Of course, there is an overrepresentation of the energy sectors and maybe also the manufacturing sectors, but still we have something which is diversified there.
Okay, thank you very much, Tristan. So I guess Kai, Mika, and Katja, if you can join me here. Maybe if you want. Okay, so it's me then. So, dear colleagues, it has been wonderful 2 days. We have I think we have learned a lot. This year we had actually quite a lot of climate-related topics. We actually got, I would say, 1/4 of the submissions were climate-related topics. So this tells you something where the research interests are at the moment. We were actually wondering what will be the next year topic, whether it's deposit flows, interest rate risk, banking sector issues. We don't know. But anyway, we are actually looking forward to see you all. Of course, new faces as well in the conference. And we want to thank you very much for the active participation, the nice talks we had around the breaks. And we hope that this created a network that stays in touch and shares ideas. And yeah, thanks again to everybody. I don't know if...
That was excellent speech.
This is the Finnish way.
Thank you.
Kiitos. And now